Oh, come on. Good evening, everyone. Please, can you hear me?
Good evening, sir. Can hear you.
Good evening, sir. We can hear you.
Good evening, sir.
Thank you very much. Uh, okay. First of all, uh, if you are listening to the sound of my voice for the first time, please can you signify? If you are hearing me for the first time, please can you signify? Just use up your hand, let me know. Oh, this is quite a lot. Uh, okay. Thank you. Thank you. I think I'm seeing about 10, 15, 20 people listening to my voice for the first time. Anyways, let me help you with an introduction. Let me share my screen. So I hope each and every one of you can also see my screen, yeah? My screen is being shared. So if you are not seeing, maybe it's from
Yes,
your
sir.
end. Anyways, for people that are listening to my voice for the first time, my name is Sulaiman Alanshili Amogbola. I'm a chartered stockbroker. Please, can you help me with your mic, please? Please. I'm chartered accountant and a chartered stockbroker. Okay. Yes. Godwin, please, can you help me with your mic, please? Anyways, like I was saying, and I'll be taking SFM. I'm taking the revision for this strategic financial management. We started this class, or people that have listened to my voice, or people that have been in my class for a while. So we started this class since January, and this is our intensive revision week. So this is my name. You can call me Ola. You can call me Shile. You can call me Suleiman. But please don't call me Omobola. That one is for my babies. Anyways, uh, that is my name. Some of
So
you
we are
are
not your
met.
babies.
You people are my book babies, not the kind of babies. Leave that one. Let's face what we came here to do. Anyways, so that's that for that. So we'll be taking strategic management together for the next 2 weeks. Yes, the class is being recorded, Mr. Taiwo. Thank you very much. So I'm taking strategic financial management together for the next 2 weeks. Now, before I run into it, let me apologize for coming. I actually did not come late. Some people were having corporate reporting, so I had to wait for them. So that's why the class started a little late. Number three, this is for people that are listening to me for the first time. Please, I have some rules and regulations for my class. This is SFM now. I have to be proud. It's not audit, it's not tax. Anyway, so I have some rules and regulations for my class, which are, please, if you are not calling figures for me, and I'll pick people that will call figures because this is a large number. You can put your hands down now, please, everybody. Thank you. If you want to tell me something later. But like I'll pick a particular number of people. Not number of, I'll pick about 2 or 3 people. So those are people that give me figures. They are the ones that call questions from. This is a large number of class. So I cannot afford everybody talking at the same time. No, we will not get it. I will not be comfortable with it also. So I'll pick about 2, 3 people. Those are the people that give me figure. But I will always, I'm proud now, it's not easy. But I always want you guys to also, if you're not giving me figure, just be pressing the calculator by your side so that you are sure that they are not giving us poison. That people that are calling figures are actually calling the good figures for us. So please, that's please don't let us. If you are not calling figures for me, please don't unmute yourself. I'm begging. If you want to ask me any question, just raise up your hand, please. This is 183 people. If 5 people should unmute at the same time, the class it will cause havoc in the class. So if you want to ask me any question, note it down, then raise up your hand. People that know me know me. I always take time to ask or to take your questions. So like that, it gives us orderliness. Then you will enjoy the class, you pass your exams, and I'll have peace of mind also. So that is that's for that. I think that's all. Time is fast spent. I think we can get right into it. Please, you have people that are raising up your hand want to tell me something. Adeshola, you want to tell me something? Oh yeah, oh yeah, oh yeah, oh yeah, oh yeah, oh yeah, oh yeah. Nina, you want to tell me something? Please, if you're not telling me anything, you can put your hands down, please. Anyways, thank you very much. I think we can get to item 8. So I sent a material to the group chat. So I sent the material to the group chat earlier, which is a question bank. Now, that question bank consists of topics that we've treated in this class, or topic that anybody that wants to write exam when next month. Sorry, is this month though? Next 2 weeks, I mean, anybody that wants to write exam should be familiar with. So those are the topics that are in that question bank. Now, I plan not to start lecturing from beginning. I've been doing that since January, so I'll just be solving those questions. Although, if I see the way we are solving them, maybe we still have time. I can add more questions to them. But I feel like those questions are actually heavy enough for us to actually deal with. So I think that's for that. So the question is on the platform. So that's the question. That's basically the question we'll be using. So, like I said, that I'm not going to be what's the name now? I'm not going to be explaining or teaching again. But what I've decided to do is maybe over the time when I start, I would be what's the name? I would be what am I saying? I would be explaining. You guys can hear me now.
Yes, we can.
Okay. So as I was saying, as over time, as we are solving, I'll be asking you questions. I'll be explaining some other things, so you can definitely jot from there. Also, is that fine?
Yes, sir.
Thank you very much. Let me look for people that can call figures for me and read questions for me. Mr. Godwin, you want to tell me something? Godwin, if you're not telling me something, you can put your hand down, please. Godwin, Mike, I can hear you. You want to tell me something? Mr. Kingsley, I can hear you.
Okay, good afternoon, sir. Good afternoon. Sorry, good evening, sir. Good evening, everyone. Please, I just want to confirm this, our revision class, intensive revision, is it going to be done every day or just according to the timetable that you shared?
According to the timetable, please.
Because our time frame is short. All right, no problem. Thank you.
Yes, thank you. And please, let me pass the information again for people that have not seen it. According to the timetable, we're supposed to have class tomorrow, but please, it has been moved to Monday. Please, so it's now Monday, 8 p.m. on Monday, please. So the class tomorrow is not going to be advanced tax that comes tomorrow. Thank you. So, Miss Chika, Alpha, you have a calculator now.
Yes, sir.
Miss, thank you. Please, you call figure for me. Angela. Okay. I'm going to look for people that call figure for me, please. Give me 1 minute. Sorry, 1 minute. I know people will be asking me that why am I scrolling? That is if there is name everywhere. I don't want to call those men. Now women are defined. Ibukun Lua, please are you a calculator?
I call man though.
No want. Now go they give me a headache. Ibukun Lua, please are you a calculator? Oh yeah, let's start though. Luciana, are you a calculator? Okay, Miss Mary Oluwadamilola,
Yes,
are
sir.
you a calculator? Okay, Luciana, thank you. Mary Oluwadamilola, Miss Mary, are you a calculator there?
Yes, sir.
Okay, so Miss Mary, Luciana, and Miss Chika, please, those are the three people that call figure for me, and they also read the questions for me. Please, any other person, just confirm the figures. If they make mistake, you can speak out, but don't. What would I say? Don't interrupt our class, please. I'm begging. Only if the figures are wrong, go before we chop poison fire. If the figures are wrong, fine, you can speak up. But if you are not giving me figures, I will appreciate a very, very silent class. If you want to tell me anything, raise up your hand. I'll call you after. Ladies in the house, permission to fire on.
Go on, sir.
Fire on, sir.
Thank you very much.
Carry on, sir.
So let's start. So
Fire.
those I say ladies, this man will not respect your gender. Anyways, as I was saying, or what was I saying? Okay, so those questions are in the question bank. So we'll start from there. So those topics, the questions, I just looked at them and I felt like, okay, maybe I love this question. Maybe it speaks about topics or things that I feel like you guys would want to have problems struggling with in exam. Like I always tell my people, those questions in the question bank or the question that I later picked out are questions that, believe me, if you are seeing them in the exam for the first time, like first time, you've never solved anything relating to it before, you have 80% chance of failing it. Yes. Like those are those kind of questions that, okay, you're just saying them for the first time, there's 80% chance of you failing it. So that's why, okay, let me just teach you the basics. You understand it, you know how to go about it. So I'm not saying that's the exact question that will come out, but at least you understand the basics and how to go about related questions. So those are the questions that are there. So let me call this revision working note. Because after every class, this working note will be sent to the platform. Thank you very much. Now, before they read question 1 for us, please let me go to the material. Let me check some things myself. Now, this one is me that will read it by myself. I'll read it for you people. Disclaimer: the questions provided in this revision material, they are intended solely for educational and preparatory purposes. They have been compiled from a variety of credible academic sources and past references. This is the most important, because underline themselves. There is no guarantee that these exact questions will appear in any upcoming examination. Students are encouraged to use them as a guide to enhance their understanding and practice across key topics. Please, on the day of your exam, if you don't see any question from this question bank, don't call me. No, that man don't even sabi anything. No question. I'm not saying nothing will come out. They are just for preparatory purposes. And for the purpose of this class, I've picked some of these topics that, although some of them came 2, 3, 4, 5 times, some are integrated into another. Yes, some are integrated into another. So we'll speak about all of these topics by the grace of God for the next 2 weeks. So this is our first question. So somebody from my beautiful, amazing ladies can help me read, please. Somebody from my beautiful ladies I picked can help me read.
Question 1. Kings and Queens PLC and Queens PLC both manufacture and sell household equipment. The summarized income statements of the two companies for the year 2012 are as follows. Kings, we have revenue, we have operating expenses. Each company has earned a constant level of profit for a number of years, and both are expected to continue to do so for the nearest future. The policy of both companies is to distribute all profit as dividend to ordinary shareholders as they are earned. None of the companies has any fixed interest capital. Details of the ordinary share capital of the companies are as follows. Kings PLC, Queen PLC, we have shares ordinary authorized issued. The ordinary share of King PLC has a current market value of 3 naira 50 kobo each ex-div, and those of Queen PLC a current market value of 1 naira 50 kobo each ex-div. The directors of King PLC are considering submitting a bid for the entire share capital of Queen PLC. They believe that if the bid succeeds, the combined sales revenue of the two companies will increase by 1,500,000 per annum, and savings in operating expenses amounting to 1,250,000 per annum will be possible. Part of the machinery presently owned by King PLC would no longer be required and could be sold for 2,500,000. Furthermore, the directors of King PLC believe that the takeover would result in a reduction of the returns required by the ordinary shareholder to 10%. Required A. As a financial consultant to King PLC, advise on the maximum price that the company should be willing to pay for the entire share capital of Queen PLC, showing clearly the basis of your advice. 6 marks. B. Show how the entire benefit from the takeover will accrue to the present shareholders of King PLC, assuming that the takeover price is agreed at half of the figure you advised, and the purchase consideration will be settled by an exchange of ordinary shares in Queen PLC. C. Discuss briefly any other factors that the directors and the shareholders of both companies might consider in assessing the acceptability of the proposed takeover. D. List any 5 defense tactics that could be used by Queen PLC to frustrate the takeover bid of King PLC.
Thank you. Thank you very, very much, madam. Thank you very much. So now, like I said, I was going to do. Before I even start, let me ask you guys a question. Let me ask you guys a question. For people that were in my class or that have been in my class, what are the 5 I mentioned? I told you guys, please, if you're not in the class, you can jot from what they are going to say. So I said that I told you guys some of the questions that might come out, not like most things that they ask. What are the things I said?
Business business valuation.
Yes, please. You guys not get my question. In that day, we spoke about 5 possible things that they might ask. What are they?
Synergy, maximum
Synergy,
price.
maximum price.
Acquisition premium.
Acquisition premium.
Then you talked about interwoven questions.
Now let me ask. Let me write them down. You guys said synergy, maximum price, minimum price. Kitoni. Acquisition premium.
Benefits to shareholders.
Net benefits. What's formula for synergy?
Post-acquisition value minus pre-acquisition value of the independent companies.
Post-acquisition value minus what?
Pre-acquisition value of the independent companies.
So what you are saying is you get the post-acquisition of the combined company, and you now get before the acquisition of the 2 companies. You value the 2 companies individually. So whatever you get, you subtract it from the post-acquisition value. That's synergy. I'm coming somewhere. Just listen. Just follow me. That's synergy. What is maximum price?
Is the value of combined company minus value of predator company.
Value of combined company minus value of predator company. Predator company is the acquirer. Sorry, acquiree. Sorry. Predator is the acquiree. Target company. We have target, we have predator. Predator is the acquirer, is the one that wants to acquire a company. Why target company is the one that wants to be acquired? Is the target, is the acquiree. So predator is the acquirer, target is the acquiree. So maximum price now is the value of combined company minus value of the what? Predator company. That is the acquirer. Good. Acquisition premium.
Purchase consideration minus value of target company.
Purchase consideration minus value of target company. Good. Net value to shareholders.
Synergy minus acquisition premium.
Synergy minus acquisition premium. Thank you. Last one. Minimum price.
It's just the value of the target company.
Value of the target company.
It's just the value of the target company. Thank you very much.
Value of
you are awake. Now, let me now go to where I'm going to now. For people that have never been in my class or you've never heard anything about business, this is a revision class, fine. But I'm still going to explain to you. So for people that have never heard anything about business valuation and mergers and acquisition before, let me run you guys straight. Now, if they say You put here mergers and acquisition. Please, I'll just be very brief with the summary, please. Mergers and acquisition and business valuation. Mergers and acquisition is just purely theory, please. It's just purely theoretical. And I used to send the material to the platform, so I'm sure most of you have the material. But anyway, whenever you hear anything called mergers and acquisition, it's different. Some people tend to use them the same way. Mergers, two companies coming together, bang, they form a new name. I used to use but don't let me go there. So mergers and acquisition. So mergers, two companies, one company A, company B, they come together, then they form a new name. That is what merger is. But acquisition, the company is particularly just acquiring another company, still maintaining its name. The example I like to use is Access Bank and Diamond Bank. Access Bank fully acquired Diamond Bank. I don't think you see anything called Diamond Bank now because it's now under Access Bank. So they've acquired themselves. So Access has acquired Diamond. So it has changed. So the name is still now Access Bank. But if it was merger, the two of them will merge together, they will form a brand new name. So that's what mergers and acquisition is. There is a full material. There's a full material on these mergers and acquisition anyway. So because we have types of merger, we have what we call horizontal merger, we have what we call vertical merger, we have what we call conglomerate merger. I'm just saying all these things to just tweak your memory. I'm just saying it to make you know that okay, you've read or you've not read. So I said we have what we call horizontal merger, we have what we call vertical merger, we have what we call conglomerate merger. So we said horizontal merger is when the same, what's the name? The same production level now, Abi, the same product line and the same market and the same production level. I give an example where I said, imagine a merger or a company that merges, like let's say a company that produces tire, Michelin, that produces tire, and another company that produces tire. That's an horizontal merger if they merge together because they are in the same line of production and they are in the same level. What level means is production of tire is different from production of the whole vehicle now. Production of tire is a level of production. Production of tire is a level of production. So imagine a tire company merging with another tire company. That's horizontal merger. But for vertical merger now, vertical merger is where two companies, they are not, how would I say it? They are not particularly in the same level. They are not in the same level of production. So what it means is maybe, let's say a tire company now goes to merge with maybe a full car company. That's something like a vertical merger because they are not in the same level of production. And but when you hear of conglomerate merger is not even, they are not in the same business at all. They are not in the same business. Say a tire company goes to acquire maybe a liquor company. They are not in the same, they have no common business area at all. That's what conglomerate mergers are. Although we have other types of mergers, we have concentric, we have purchase, like that. But those ones I mentioned are the most common ones. We have advantages of mergers and acquisition. We have reduced cost, synergy, efficiency schemes, competitive advantages. We have disadvantages of mergers also. Job losses, reduced competition, diseconomies of scale, blah, blah, blah. So now let me explain synergy for people that have never heard synergy before. When you hear synergy is the, when you come to SFM, they tell you 1 + 1 = 3. That is what synergy does for you. Because synergy means that there should be an additional profit, or there should be an additional value, not profit now. There should be an additional value when two companies merges together. Please, let me give somebody a job. For one of the people that gave me those formulas, please let me write it in the chat box. Please. All those formulas I gave, I don't want to type it. It will take my time. Please, somebody help me write it in the chat box, please. I'm begging. Thank you very much. So I was saying that synergy is when there must be an additional value when one or two companies merges together. So now, when company A and company B comes together, I must not be the way I am or the way I was before I merged with you. There must be an additional value. That is what synergy is. And synergy can be in form of cost, in form of revenue, in form of financial synergy. Please check all those things in the material. We have reasons for mergers and acquisition, tax benefits, staff reductions, a lot of them. And methods of financing mergers and acquisition also, we have the share exchange. All those ones are the theory parts, please. We also have what we call defensive tactics or defensive maneuvers for mergers and acquisition. We have the green mail, the macaroni defense, the people's pill, the poison pill, the sandbag, the white knight, like that. Now, what I told my students was, I said that for mergers and acquisition or business valuation in general, it's just business valuation part that is calculation. And those 5 things that somebody is going to text in the chat box, they are majorly the things they ask. Either they ask you to use synergy. After they ask you to calculate synergy, calculate maximum price, calculate minimum price, you calculate net value to shareholders, or you calculate acquisition premium. Usually, those are the 5 ones. Now, the problem now is, now you know what they want to ask. This question asks you to calculate maximum price. And where do I start from? That should be your next question. I have known that is maximum price. I know the formula for maximum price. Value of combined company minus value of predator company. But like I know. Now, what do I do next? Now, what you now do next now is there are different methods for valuation. Listen to me, Egbo. There are different methods for valuation. You can either use your dividend valuation method, you can use your earnings valuation method, you can use your free cash flow. Those are the common ones. Those are the common ones of valuing when it comes to business valuation. Those are the common ones that you can use, that they ask generally. I said earnings valuation, you can have dividend valuation, then you can have free cash flow. Those are the 3 ones. Now, what is the formula for dividend valuation? If I want to use dividend valuation model, what is the formula? You know, this is your D1, open bracket, 1 plus growth, close your bracket, over what? Your cost of equity minus what? Minus your growth rate. I said D01, open bracket, 1 plus G, close the bracket, over what? Your cost of equity minus your growth. That is if you are using dividend valuation. It's the same thing if you are using earnings valuation or earnings method or earnings yield. It's the same thing. Your dividend just changes to your earnings. Your dividend just changes to your what? It just changes to your earnings. If you're using free cash flow, either free cash flow to firm or free cash, I will explain those ones to calm down. Either free cash flow to firm or free cash flow to equity. It is still the same formula. Yes, the dividend, just remove the dividend, put free cash flow there. If it's free cash flow to equity you are looking for, put it there. If it's free cash flow to firm, you put it there. Those 3 are the ones that are very common. Now, the problem now is, now I know the method to use. But with this question, how do I know the one to use? Mr. Ashley, you spoke on it, I know now. How do I know the one to use? Believe me, no, I can question. As I said, I want to give maybe calculate maximum price. That will not tell you calculate maximum price using dividend valuation. It not happen for you. No, you will not see it now. No, I can't question will give you that. So what they do is the question will be structured in a way that the information passed will determine the method we use. Chemba. For people that don't understand you, but Shemba means are you meeting it? But in your mind, you will not answer me that I'm bar. So it means you are meeting it. So now what I'm saying is the information given will not determine the method you use. Now they've cooked question. You are saying dividend. It's sense now. Sense will tell you that okay, this should be all the information I have could be for is for dividend valuation. But you're already saying profit or loss. You are saying earnings. They're saying that their earnings is going to grow by a particular percentage. It means you are supposed to use your earnings valuation now. But if it's free cash flow is the only one that is stated expressly that use free cash flow to equity or use free cash flow to firm. And why is it stated expressly? Because there are 2 different options now. You can have a free cash flow to equity or free cash flow to firm. So anyone that it is, they will tell you the one to use so that you don't just use anyone that is from your church mind. So they will tell you the one to use. That's why I say it's free cash flow to equity or free cash flow to firm. So now let me branch there a little bit. Now with free cash flow, now we have structure or we have method for free cash flow to equity. I also have structure or format. Let me call it format. And format also for free cash flow to firm. So if it's free cash flow to equity, there's a format for it. If it's free cash flow to firm, there's also what? A format for it. Please check our materials and check those formats. What I will do, I'm not promising, but if somebody can do it for me, it will be easier for me. Somebody please do it for me. Check all our group chats, or if you're in any group chat, send me all the materials we've used. This I changed my phone, so I lost some of the materials. Please send me all the materials we've used for this diet, plus the working notes. Let me forward it to this revision group chat so that for people that maybe you've not been following, you can easily scroll through. Yes, I think it's easier that you can easily just scroll through. Sorry. So somebody do that for me, please. Send me plus the working notes. You send me all the materials we've used this diet, both my part and not my part. Just send me everything. Also send me the working notes so that I can pack up everything and forward to the group chat. So people that have not been in the general class or have not been participating. Now let me go back to what I was saying. Free cash flow to equity, free cash flow to firm. there's a format. There's no big deal there. I think we'll solve questions on it. Anyways, whenever you're doing free cash flow to equity, discount your free cash flow to equity with your cost of equity and discount your free cash flow to firm with what? With what? Yeah. I'm asking the class. Eshe. So you discount your free cash flow to firm with your weighted average cost of capital, or you discount your cost of your free cash flow to equity with your cost of equity. So those are all the grammars there. Now that I've explained the basics to you, now let's go back to that question. Now with all the grammar of the question, with all the things Mrs. Luciana has left for us, what method do you think we will use? I'm asking the class.
Dividend valuation method.
I'm hearing dividend. Good. I intentionally asked. Thank you. Now, for people that said earnings, for people that said dividend, you people are actually on the right track. You people did not just read the question very well. It's dividend valuation we use now. Why are we not going to use earnings? Listen up. You see that, okay, obviously we have earnings information here, which is very, very fine also. But now calm down, read your question. They now said that ordinary shares of King has a current market value of this, ex-div, a current market value of this. Fine. This is where the answer to that my question is. They now said that the directors of what? The directors of
King's PLC.
The directors of King PLC are considering submitting a bid of entire share capital. They believe that if the bid succeeds, combined sales revenue will increase by this. Combined sales revenue will increase by this. Operational this will increase by that, which makes perfect sense. Part of the machinery. So there is no information on dividend at all. So we cannot use dividend valuation now. There's nothing on dividend at all. No grammar that mentioned dividend in this question. So it's earnings valuation we use now. So that's just what I just wanted to know. You just read the question, you will know what you are supposed to do. See, they said, believe that if the big source combined sales will increase by this, operating costs will reduce by this, machinery owned will no longer be required. There's nothing on dividend at all, Seth. So we cannot use dividend valuation. So what we use now is we use our earnings valuation. And I told you that for earnings valuation, our formula is our earnings 1 plus growth. If there is growth over cost of equity minus growth. In this question, is there any growth relating to our earnings? I'm asking the class. No. So there is no information on earnings growth. So it means that 1 plus G, remove it from the formula. So the only thing you're using now is your earnings over what? Over your cost of equity. No baton. That's how you'll be breaking these questions down in exam. That's how you'll be splitting it. Be asking yourself, be answering by yourself. First question, what method am I going to use? Done. Go to the question, read it through. Information's given to you. Now, because of this information, now you've read it, you're not seeing anywhere dividend, you're not seeing anywhere free cash flow. But because of, you have profit or loss comfortably here, you have your profit or loss, you have your earnings here. So you can use your earnings comfortably. You have information for earnings comfortably. So you know that you are using your earnings valuation method. So let's solve. So let me leave this here. I think somebody has sent it to the formulas to the platform. So to the what's the name? To the chat box, so you can easily copy them from there. Somebody's unmuted, please. Whenever I say somebody's unmuted, I'm expecting everybody to check their mic and confirm if it's them. So the first one, we are calculating what maximum price will be. What's formula for maximum price again?
Value of
Value
combined
of combined company, Abi.
Yes.
Value of combined company minus what? Value of predator company. In this question, who is the predator?
Kings.
I've told you, predator company is the acquirer. It's the one that wants to acquire. Target company is the acquiree, the one that wants to be acquired. So now we said value of combined company minus value of predator companies. So let's first calculate our value of individual companies first. Let's calculate those ones first. The value of our individual companies. So you say, let me now say value of individual companies. Let's say boom. But the thing is, if you read the question again thoroughly, there's also no information. Not like there's no information. There is no, how would I say it? There is no earnings for individual company. Let's go back. What I'm saying is, if you read this particular question, they did not give you information particularly that you can use to calculate the earning using earnings value for each company. Say King, this one, that one. No, you cannot do it like that. So what you will now do is you will now say you calculate the total value of each of the companies. So that's what we are trying to calculate now. So you say calculation of market value. So after this, you now say, let's do one by one. So let's say King PLC, Abi. So if you want to get this market value now, so that you get the total value of shares, you get the total value of King, you get the total value of coin also individually. So you now say market value is equals to number of shares multiplied by what? XDiv share price. We have XDiv share price now. That is what they are for. XDiv share price. So what's number of shares for King PLC? What's the number of
50,000. 50,000.
50,000 shares multiplied by what? What's the XDiv?
3 naira 50 kobo.
3 naira 50 kobo. What do I have?
175,000.
175,000. This is the market value of King PLC. So you come here again. You say Coin PLC, Abi. So what's the number of shares?
25,000.
25,000. What's the exit share price?
1.5.
50 kobo. What do I have?
37,500.
37,500. So this is the value of what? Of individual companies. Simple now. It's very, very simple. In other questions, okay, I think we'll solve questions like that so you would know. In some methods or in some questions, if you want to use dividend valuation, it depends on the structure of the question. I feel like that's why I always tell students. Business valuation, other students don't like it because it comes in different ways. In some questions, you will use the dividend valuation to calculate the value of individual companies also. But because according to this question now, we don't really have, okay, now, hold on, let me show you guys something. Or let's check something together. If I wanted to, what's the grammar now? If I wanted to, let's assume I want to use earnings valuation method. Listen, because I'm sure what some of you people are thinking is, why can't I use that earnings valuation? That is the earnings 1 plus growth over cost of equity minus growth. Why can't I use it to calculate the value of each company? Thank you very much. Since each company actually has their own earnings here, if this King's earnings 17.5, if this one is this one's earnings 4,500, why am I not using it to calculate the valuation? I'm sure that's what is in some of you said. And listen now, what's the formula for calculating earnings valuation? Earnings over cost of equity. I said they have their own cost of equity. Is there information on individual cost of equity here? No, now it's only combined companies that they have. I've told you, information provided for you determines what you will do. Please pay attention. I've told you, don't cram, don't be so, how would I say it? Don't be so congested. SFM is very dynamic. Don't just think, okay, this is the way we be. There's no way it will be. It's questions that determine what you will do. Each company don't have cost of equity, so it will not work. And now they've given you their shares, their current market value. You have the number of shares. Another question that you can be asking is, okay, why am I using issued? Why am I not using authorized? Authorized shares is different from issued now. Authorized shares is maybe at the beginning of the year or at the end of the year. They authorize that, okay, everybody, they take, I don't know, 2 million shares. But that is not the actual share that is issued now. In any question like this, please don't use authorized. Always use issued. Authorized does not mean that's what came out. That's what they sold. So this is issued. Please always use issued. I hope I'm fine. Thank you. So that's the value of the individual company. So now the next one, let's do value of combined companies, please. So you now say value of combined companies. But for this one, we have cost of equity for combined companies. So it's easier to use that formula or to use that method. But first, now let's read the question forward again. So they said that they believe that if the bid succeeds, this one now is now information relating to what? The combination. Now they've come together. That if the bid succeeds, sales revenue of the two companies, it will what? It will increase by 1,500,000. Fine. And savings in operating costs amounting to 1,250,000 also will be possible. Now, the next thing you will now do is, so you will now say, so you come here. So there are already changes when that's the synergy I was explaining to you earlier. So they already know that there will be synergy. Sales increase in increment in sales, reduction in what? In operating costs. So you now come here. See, so let's say calculation of what? Of adjusted earnings. Bam. So you now say something like this. Let's use a table. So let's do something like this. So you say, let's do kings. So you say kings. Abby. You say queen. You say they have changes. And you say the total. So you come here, let's say revenue. What's revenue for king, please? Oh, yeah. What's revenue for king?
37,500.
37,500.
37,500. For queens, uncle?
50,000.
20,000.
20,000. What's the changes? Like, what happens to it after combined together?
It will increase by 1.5.
It will increase by
So it increase
1,500.
by 1,500. So what's the total? What's the total?
9,000.
9.
59,000.
59,000.
59,000. So you come here, you say operating costs. So once you come here, you say operating cost. What's your operating cost?
20,000.
1,250.
20,000. For queens, uncle?
15,500.
15,500. What's the changes in the operating cost?
1,250.
1,000.
250.
What's the total?
36,750.
36,750. So what's our total earnings? So you say total earnings. For this one is what? 17,500. This one go 4,500. This one go 250.
So please, our operating cost is 34,250 because it's reduction.
Reduction, sir. It should be a positive value.
22.
What is this one's answer?
22,250.
22,250. And savings increased by, can you hold on, please? And savings in operating cost amounting to 1,250,000 per annum will be possible. Okay. So when they save in operating costs, what does it mean? When they say savings in operating savings in operating expenses. So what savings in operating expenses means is, what was the amount they spent before? Somebody's unmuted, please. So they spent 20. King used to spend 20,000. Queens used to spend 15,500. So what they are now telling you now is that there will be savings in the operating expenses. That is, the operating expenses that you are spending before, it will reduce. There will be savings in it. It will reduce by 1,250. That is the gamma debut. So you come here, do something like this. So what do I have?
250.
Inbo. I cannot hear you.
34,250.
34,250. What's my answer here? This one to changes. This one is 2,750. What's my answer here?
24,750.
24 what?
750.
So now let's not go and calculate market value.
24,750.
So we now say market value is equal to you say earnings. Since we don't have good rate now, our cost of equity equals to so our earnings is 24750. That's our cost of equity. What do I have?
247,500.
Go
247,500.
247,500. But don't forget, there is something in the question also where they spoke about what's next. I was saying part of the machine presently owned by King will no longer be what? No longer be required, and it will be sold. So it's also part of the benefit from combining together. Yes, now I told you that these are synergies, synergistic benefit that comes from the combining of the two companies. So because they come together now, let me give you an example. When Access Bank and Diamond Bank, when they were doing their mergers, don't you think there will be some all those counting machines that will be sold? Yes, now, because the two of them, they have enough before. Now they've merged together, so some of those will be sold. So whenever you see any extra assets that was sold, it forms value of the combined companies. As long as they are selling them all, not as if they are dashing them out. As long as they are selling them, it forms what? It forms part of the, it forms value, part of the value of the combined company. So you now come here. Especially. Sorry, so you now come here and say machine disposal. How much is it?
2,500.
2,500. So what's the answer?
250, sir.
250,000. So from here, you will now say maximum. You know, please, all these ones here. I think at this point, people should know this is a professional level. People should know how to answer ICANN questions. Please, all these things, let me help you. Exam is already here. Don't let me be. So all these ones, they are what? They are your workings. So this is the only thing that is supposed to be in your front page. This one was supposed to be at the back. This is the only maximum price. That this one should be in your working space. So you now come here, you say MP, which is the maximum price, is equals to. So what's the value of our combined companies? We said 250,000 minus. What's the value of Predator
Sorry,
company?
sir.
That's
I think my network was pretty slow. Can you tell us what is supposed to be at the front again?
175,000.
175,000. So what do I have as the maximum price?
$75,000.
75 per. How many marks is it?
6 marks.
6 marks. As simple as ABC. Now let me ask you guys a question. I told you that minimum price is what? Okay, shall we will not get it? Don't worry. I'm just to ask minimum price, but you might need to have. Okay, you will get it now. What's the minimum price? You'll get it.
I think value of the target
Of the
company.
acquiree.
Which is value of now. So that
37,500.
would be 37,500. So that's the minimum price. That is, you will not collect anything less than its value. You will not anything less than its own value. You will not collect. So minimum price that it will collect is 37,500. It's not in the question. I'm just asking. So before I move on, let me take a few questions, please. So if there's, please ask me. Please raise up your hand. Let me. If you want to ask me anything, let me see. Please, is it clear? Esther, talk to me, please. Real quick. Time is gone. I want to be solving three questions per class.
Thank you, sir. I can't see your screen, sir.
I think it's from your end, sir. Just try to maybe log out and log in.
Okay, sir. Thank you, sir.
You're welcome. Eric Oni, please.
Please, can you go back to working? I've not complete. I was just writing on the adjusted earnings, calculation of adjusted earnings.
Want to ask me something there?
No, I just want to complete what I was writing. Thank you.
No, don't worry. This material will be sent after the class. So you can always write it there. Thank you. What else? Nothing I won't use the material do now. Prosper, your question. Oh yeah, fast, please. Prosper, come on. Prosper Chimere Muma is your question.
Yes,
Prosper.
sir. My question is, I joined late. What's the question we are solving? Where is it from?
The material that was sent to the group chat.
Number what?
Number 1, ma.
Okay, sir. Thank you.
You're welcome. Favor, your question. Real quick, please.
All right. Good evening, sir. Okay, so
Good evening, ma'am.
when you read the question, you were like, it's earning. Like the question was directing us to solve earning. Can you brush us off on how to know? Because me reading the question, I'm feeling that it's supposed to be dividend. I don't know, sure. Like, how do you guys like to read the question?
Why would you have used dividend?
Because they're talking more of dividend in the question. Then you stopped and you said no, it's earning that we're solving.
Where did you see? Tell me the places that dividends are.
Okay, they spoke on the company having the current market value and each ex-div. They spoke on the what's again? Wait, it's only one partition.
You can't find.
Yeah, I can't find, but it's
those are not. Listen. Don't pressure yourself. It's the way you read the question. There is no information here including that even concerns dividend. This ex-div you are saying, whenever they say something is ex-div, what it means is excluding dividend. So what they are telling you is, okay, the current market value of this company is 3.5. That is, they've paid their dividend. It's excluding dividend. For people that are stock, that you know anything about stock or shares, I'm sure you relate to what I'm saying. So what they are saying is, this is their current market value, excluding dividend. That is, dividend is not included at all. This is just the normal price. So this ex-div that you are saying is more of qualifying the market value or the market price of the shares, not anything related. There's no information on dividend. Now, there's no free cash flow, there's no free anything. And I've told you, when it relates to earnings, you will see most of their profit or loss here now. Even when you're doing dividends, sometimes fine, you can still see profit, you can still see profit or loss there, which is fine. But there's no information on dividend, no information on free cash flow or anything. And yeah, now you're still seeing things like operating expenses is reducing, sales revenue is increasing. I don't know which other sign that would have, but like I feel like this is enough.
Yeah.
Let's
It's enough.
But I'm
It's
sure that
enough,
when we
thank
solve
you.
more questions, you see the relationship.
Yeah, I guess so. Thank you.
You're welcome. But these questions are too much. Oh yeah, Folashade, for this simple question that we solved like this.
All right, thank you. Yes, please. I have two questions. Number one, the operating costs for the changes. I don't know, why do we have it? Are we not supposed to subtract it? The
Normally,
1,250.
normally, being an operating cost is supposed to be subtracted. From
Yes.
you see the way our profit or loss has been coming now. So operating costs and expenses. But according to the grammar of the question, they now said that and savings in operating costs. That is, when they say you saved something now, let's say okay, you are supposed to spend 20, you spend 20,000, or let me say you spend 2,000 on transport fare every day to work. Do you understand? You spend 2,000.
Yes.
So you now say that maybe today you saw free ride, so there is savings in your transport costs. What do you do to that normal 2,000 naira? Like, what happens to it? You will not spend up to 2,000 naira again now. So you not spend up to 2,000 naira.
Yes,
so that
thank
is the
you so
grammar.
much. I got it perfectly. Yes,
Thank you.
okay. Thank you. So the second question quickly is that if we calculated the value of the predator first, and we now calculated the value of that's king and queen. But I'm thinking if we had the two together and now go and have the disposal, are we not still going to get the 250? Or we have to ignore the one we calculated for the queen beforehand? I don't know if you get my question.
I get what you're trying to do. But this one might work. Add it 137, 175 plus 37.5. What would it give you?
No, it didn't work.
It will not work
It's
now.
not giving me the same thing.
It will not work.
Yes.
Exactly why it will not work is that value of individual companies. It does not mean that I've explained synergy now. It does not mean that when the two of them combine together, it will give them the exact. That's what they are trying to avoid. Imagine I want to marry a wife now. What is in my account is 1,000. This one might not work, and I could just laugh, but I will still use it. I want to marry a wife now. What is in my account is 1 million naira. What is in my own account is 1 million naira also. My own expectation is when we marry, my value is not supposed to, our value together is not supposed to be that to 2 million naira. Yes, now, either my sales, either my profit or my revenue has increased, my cost also has reduced, so that 2 million naira will not be the same. So that's the purpose of what they are trying to acquire, to gain when they merge together. So the value is not supposed to be the same again. That's what synergy is saying. Okay, they've combined together now. Their value is supposed to increase from what they were as individual companies. That's why we have to adjust all those earnings. All those things we adjusted, the revenues, the operating costs. That's why that addition would not work.
Perfect. Thank you. Thank you.
You're welcome. Yeah, Mr. Benjamin, fast. Time has gone.
Yeah. My question is, after adjusting the earnings, will it be proper or out of place to add that disposal value before dividing it by the
will it be what?
I said, after adjusting the earnings, will it be proper or out of place to add that disposal value before dividing it by the current market share, something like that? I don't know if it's
okay. I think I get what you're trying to say. So what you're trying to say is, Mr. Benjamin, please tell me with your mic. So what you're trying to say is it proper that as this is like this, I be this 24750, you add it to this 25 before now dividing it by this question? Like that.
Yes, exactly.
If you do it like that, it might actually eventually work, but does not show presentation skills. No, because this 24,750 is even your earnings. It's not your market value. Kembao. It is your earnings. It is not your market value. And machine disposal is supposed to be added to your market value so that you get your total value. But this 24,750 is just earnings. It's not market value, please. So don't do that one amago. Go and do that one in audit and assurance. We don't used to do all those ones here. These questions are too much. Mr. Lucky, please, oh, Jim. How would I solve 3 questions now? Okay, Mr. Lucky, I don't think you have a question for me. Aisha, please, your question. People are asking this many questions for this simple. Oh yeah, Aisha, oh yeah, ask me, please. Okay. Ukeme.
Sorry, sir, you called
Hello,
them
sir. Good
Lucky.
evening.
Okay, I can hear you now. Mr. Lucky, talk to me, please.
Sir, please, what we did in corporate is that we finished the question before they start asking their questions. So I feel we should finish the question first before we can attend to any questions. If not, we will not go far.
But that's corporate reporting now. We are not the same person. We take our stuff different ways. Thank you very much.
Yeah, I think you should do that. So let us finish the question so it doesn't stop the
Can I
flow of
continue with my method, please? Thank you very much. That is why I'm the lecturer and you are not. Because I decide the way I want to go about it. This is strategic financial management. I cannot take it the way they take corporate reporting. It's different. Thank you very much. If you don't understand this, how do I want to move? I will stop taking the questions at one point. I know what I'm doing. Thank you very much. Oh yeah, okay, talk to me, please.
Okay, good evening, sir. Mine is not a question, it's a suggestion. I was wondering if we could place the question side by side with the solution so that we can follow properly.
I cannot. I don't think you would. I don't think you would. Whatever, I always send the question to the group chat first so that you can get it. Is that fine?
All right. That's fine. That's fine. Thank you.
So, so that I can continue, please, any other questions, please take them down. I'll attend to them later. Thank you. The next question. Show how, wait with this. So you should show how the entire benefit from the takeover will accrue to the present. Sorry. I don't know what I was trying to do. But anyways, let's continue. So I was reading the second solution that you calculate the what's the name now? You calculate the takeover price agreed at half of the figure you advised, that the purchase consideration will be settled by an exchange of ordinary shares. Now, this grammar now is 4 marks. In exam, if you don't understand it, say that maybe you leave it or something. But what they are just simply trying to let you say is, okay, this amount that you told them to buy it, which is how much? How much was it?
75 million.
75 million. Good. So now what they are now asking is, okay, how would it, assuming you are trying to do half of it, how would it benefit the takeover, the shareholders, basically? Now this is what you will do. So you come here now, you say something like, so you say B. So you say the benefit.
You can't see the screen, sir.
Thank you. Sorry. It was that thing that I locked out. So share screen. Share screen. What is happening here? 1 minute, please. Hold on. Maybe Juju this. Please, 1 minute. My screen has refused to share. People that you don't want us to have class, people should free us today. People should free us tonight. My screen has refused to share.
Sorry, sir, I cannot see your screen.
That's what I'm I will tell the complaint. Okay, it has worked. Thank you. You see, as I talk loud now, you go free us. Hey, Eshe, thank you very much for freeing us. So I'm sure you can see my screen now. Thank you very much.
Yes, sir.
Yeah, hey, madam, you have answered. Thank you. Anyways, so that's the question. So this is what you now say. So you now say benefit to shareholders of King PLC. Now, if you want to do benefit, so you say the benefit will only what's that grammar now? Okay, let me first even leave this one out. So first of all, leave this diagram, but I'll add this later. So if you want to do the benefit to shareholders of King PLC, this is what you will now do. So you say, so this is where people that went to Namina U and people that went to original school, this is where it shows. So you say, let me use maybe let's say maybe let me use X. Let me say you say let X equals to the number of shares that King PLC will issue coins. We issue coins PLC. Abi? So you now say your post-merger value, which is what? 250,000, Abi? 250,000. Post-merger, this is the one that we don't know. So you say post-merger number of shares. Don't forget, in the question, they only gave us number of shares for individual company. There is no number of shares for after they have merged together. So post-merger number of shares, you will now say equals to the number of shares of what now? Of King PLC. Plus our X. Our X here now, which is number of shares that King will issue coins. That will form the number of shares. What I'm trying to say here is, now, you know that the post-merger number of shares is the number of shares of King, that is his own number of shares, Gongo, and the number of shares that he will not issue King, that will issue coin, sorry. That, okay, out of this, my way, I take this one. That will, the combination of the two will be the post-merger number of shares. But we don't know the number of shares that King will issue coin now. That's what we are trying to determine. That's what we are trying to determine. So you now come here, you now say value, you say value per share, say value per share of coin, the value per share of coin PLC after merger. This one is equal to let me say this one is not the normal usual one, that's why. So you now say it's equal to the value of shares is your value of shares over, let me say, X. Abi? So you come here and say dum 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 dum. Oh, to that go. Let me still put it like this. So what's the value of shares? My class, what is the value of shares?
37,500.
37,500. That is the value now. That's the first thing we calculated earlier. Hey, let me show you. This is it here. See, this is the total market value. Maybe I should not. This is the total market value. Maybe I should change that into market value. But let me change it to market value. But let me have value per share, value of shares, so people will not get confused. Say total, or let me call it market value. So our market value is 37 what? It's 37,500 over X. So you come here, you say you call this equation 1. You now come here again, you say post-merger value per share. This one is equal to, you will say, this is equal to, call it, say, post-merger value over post-merger number of ordinary. It's gentle, right? You've already gentle now. Nice one. You call this one equation, can you? Equation 2.
True.
So let's do our normal. So you now say substitute. That's why I said some of these things, if you've never seen them if you've never solved something like that before, there is no way in exam now. So say substitute equation 1 into equation 2. Oh yeah. So what you now have now is, sorry on this. So what is our okay. What are post-merger value? So we are substituting this into this now. So what's our post-merger value?
5 million.
What's our post-merger value?
250,000.
So 250. Okay. So we come here. What's the post-merger? Okay. We don't know the post-merger number of shares now, but we said, what do we say post-merger number of shares is here? Number of shares of King plus what? Plus the number of shares that we issue, which we don't know. Here, what is the post-merger? What is the number of shares of King? I think 50K, Abi.
50,000.
So you say 50,000 plus X equals to, this one is clear a little bit. So we have this one, 37,500, this one here. So you say 37,500. So 37,500 over X, Abi. Oh yeah, put that went to. So what do we do now? You cross multiply now. So we cross multiply, what do I have? 250,000 X, Abi?
X. Yeah.
Yes.
What's 37,500? Okay, let me do it like this so that people will not be asking me too many questions. I wanted to do it straight before, but let me do it like this. 50,000 plus X. Oh yeah. So we are saying 250,000 X equals 37,500. You can't see it on a. What can't you see? Oh yeah, I'm used to 37,500. What does I have?
1,875,000.
875,000 plus what? 37,500. Why? So let's collect like terms. See, I'm writing it for you people. Small like this. So please be writing it like this in exam. If there is no time, fine, you can move on. This is professional. Nobody cares about this, but at all, you have to when you are solving. So sorry, you know why X.
I was wondering why coming from.
Sorry. So if you collect like terms, you now have 250,000 X minus 37,500 X equals to 1,875,000.
It's 1 billion.
It's 1 billion. Okay. 875,000.
1 billion.
It's 1
We are
billion.
working in thousands, right?
Yeah, but like, are we not going up to the power of 000 before? We were now from the
Yes,
question.
where?
That we are raising it to the power of three zeros.
Raising power,
So
power of
correct.
0 from between now. So it's 1,875. So yeah. So from here now, what do I now have?
Hmm.
What do I have? What do I have?
212,500.
212,500.
Which one is
X.
212,500?
Subtraction 250 minus
212,500 x
X.
equals to 1,875,000. So if you divide both sides by that thing, what do I have? So my x equals what?
8.82.
8.82.
So 8.82 naira per share. Per share. Good. So you now come here, you say number, that is what we are trying to calculate now. So you now say number of shares that's millionaire, that King PLC will issue Queen PLC. Abi? So you now say we have 8.8, can you know? 8.82.
82.
Put something. Dum, 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 dum. I'm looking for something, so. Oh, okay. Okay. So say 8.82 multiplied by what do I have? What do I have? What do I have? What do I have? 8 million.
8,820,000.
Yes. So let's say post merger value per share. It's just see that's what I told you, it's just 4 marks. It's something that you can gamble and you will leave it by yourself. So you just leave it, you can gamble it like that. So you say value value is unmuted. Value per share of coin. Somebody is unmuted after merger. Okay, really. So come here, do something like this. This one people are just looking at me. I just saying let him just finish. Let him finish whatever he's doing. Abi, so you say 37,500. Don't forget what we would tell. Where is it? Post major value over this one. We've gotten this post major number of ordinary shares to be 8,820,000. So you just say yes, 37.5 over get 8,820,000 shares. So what do I have? We are just doing all these things that with all these equations. We are just solving them back again. So what do I have?
4.25.
Bro. Hmm?
4.25.
4.25.
4.25. Yeah. So this is the value per share. This is the value per share. What's the name? This is the value per share of coin after this particular measure. So you are not done. No? You will now come here. You will say post measure value. How many marks is them? It's 4 marks. Post measure value per share. You just leave it. They might fill an exam. You now say, I'm just solving it for you, but I will not advise anybody attempt it. I really would not. Say post major value per share. So you say, what's that figure that we got for our market value again? 250, abi? So you now say 250,000. 250,000 over, say, I think the value of King, you said 50,000 plus. Is this thing I'm still doing? No, where is that? It's still all this tabular stuff, all this our equation, where are they, that I'm still solving. This one is the one I'm doing now. It's just all this equation that I'm still dealing with. I'm not doing anything different. I was looking for my X before. X was what I was looking for, and I've gotten my X to be, is it 10,000 shares? 10,000. Okay, sorry, these are our X. That's what I've been using now. It's 8 million 820. So this multiplied by this, we should be raising this to power of 1,000 now. I don't cook, but like it still works. It still works. So you come here, say 820. What do I have? That X was what I was looking for before, and now I've gotten the X. This is the total. This is the value. So that's what I'm just using to replace. That's what I'm just putting at the. This is still what I'm doing. It's still this equation, but I did not have X before. Yeah, it's still this equation I'm still solving. Yeah, but I did not have X before, but now I have X. So I'm just substituting X into all these things. The first one was this one I did, that's 7,500, which is the this first one. You know, you are doing value per share of coin after merger. I also doing post merger value per share. So the first one I did was value per share of coin after merger, which is this equation that is here. The X is our 8,820,000. Then this other one is post merger value per share, which is the one I'm doing now also, which is this one. So it's not anything. I'm not doing magic. I'm just putting these figures in this.
4.25.
4.25. 4.25. So what's my, so now this is now where the answer
Correct too.
is not correct. Is it correct? Abi is not correct. Let me.
It's correct, sir.
Please confirm. Oh. Confirm. Somebody help me confirm the answer now.
Okay, it's because you're adding. It's because you're adding about 8 million instead of 50 million.
Supposed to be 8,820.
I don't understand. What do you say?
It's supposed to be 50 million, not 50,000.
We are okay. Let me just remove this. I already removed it that time. I think it works now. It's 50,000 now. We are raising to the power of 000 before. That's why. I think it would work like this. What do I have? Is it correct now?
Yes, it is.
It's correct, sir. It's correct.
So now this is where your answer now comes. There's something I wanted to write at this beginning. I wanted to write something. If anybody would but I say let me write. Yeah. What I wanted to write, somebody's unmuted. Please listen here. Is the benefit. This is a trick. Oh. Whenever you see benefit, so you say benefit will only accrue. You say benefit will only accrue to the shareholders. It would only accrue to the shareholders if King PLC. If King PLC, okay, sorry, to the shareholders of, not if, of King PLC. This is a trick that you'll be using. If the post merger value equal to what? Value of coins after merger. So this is a trick that you always consider whenever you see benefit. Whatever you get for post merger value, it must equal to the value of coins after merger. Like it must be the same thing, which is what we had here as 4.25. value per share of coin after merger 4.25, post merger value per share 4.25. So you now come here, say benefit to the shareholders. Benefit to the shareholders, just like grammar, say you can do benefit. So you can say which is our post merger value per share minus what? Value per share of coins after merger. So you are saying 4.25 minus what? Sorry, 25 minus 4.25. If you first do this one in exam and you get 0, you go first fear. So you now say conclusion. So you say, if I think they said they wanted to buy it for 1/2 price, according to the question. Let me read the question again. So assuming the takeover price is agreed at half the figure here. So you now say, if the takeover price is agreed at half the price, there will be no benefit accrued to the shareholders of King PLC. Ní grammar yẹn bá tán. This one choke, abi? It choke.
I swear, it will.
It's just format. So, like I said, if you don't know what to do about it, I would just advise that maybe you leave it. So, what you will do, just calm down. After, let me brush through it again. But after, just calm down, look at it again. Just look at it when we are done with the class. But anyways, let me just brush through it again. So now, what we are trying to determine particularly is the benefit to shareholders. And now, this particular benefit, it will only accrue to these shareholders if their post-merger value, that is, after they merge together, if it's equals to the value of coins after merger. That is the only way the benefit will only accrue to the shareholders of King. Now, the problem now is, according to this our question or all this our grammar, we only have what's the name? We don't know the amount of shares, because if you want to calculate this particular value of coins, okay, now let me ask you guys, how will we calculate value of coins after merger? You've merged now, so it's very rare for you to calculate, or it's somewhat impossible for you to calculate the value after you've merged. But the problem is, you can also calculate this particular value. The reason why you will not calculate, or most of the reason, is you will not know the numbers of shares that King will issue coins after the merger. You know the market value of coin now comfortably, 37,500, which was what we calculated. You know the market value comfortably, but you don't know the number of shares that it will give it. If you know the number of shares, you could have easily divided the year, then you know the value per share of coin after the merger. So because we don't know the number of shares we issue, we are representing that number of shares with X. And if you want to also get post-merger number of shares, post-merger number of shares is the number of shares that King has gone, and the one that will give coin. Combination of the two is its post-merger number of shares. But the number of shares that will give coin, we also still don't have it, so that we still represented it by X. So now this is the post-merger value per share, is the post-merger value over post-merger number of ordinary shares. So we just got this. Yeah, so this one now, sorry. So we just got this here. So this is our equation 1, this is our equation 2. So we just substituted the two equations, then did mathematics to get our number of shares that King will issue for coin. So after all those grammar, we got 8.82. We got our number of King PLC. We issued 8,820 shares. Then post-merger value per share. So we now brought all this equation here. Since we've gotten our X now, so we can comfortably now bring all these 250 and all of them. We can comfortably now bring them to this particular equation, then get our benefit, get our value 1, then do our benefit to shareholder plus measure value minus this to get our answer. I know there are questions, but hold on with your questions. Let me complete. Let me answer. Let me look at other questions so that I pick all the questions together. So this one says C part. That's all for the B part. So if I were you see why I always tell you guys that, you see, for anything in this life, don't ignore your theory parts. Because now, looking at it, you could have comfortably gotten these 6 marks comfortably. Discuss briefly. This one is theory, 5 marks. This one is another theory, 5 marks. That's 6 plus 11, it's 11 plus 16 out of 20, which is not bad. It's even very, very good, safe. But some of you don't even know the theory. Number 4, you will not know it. So it's only this one that you will not be struggling with. So don't leave your theories, please. So this one is saying that you should, what's the name now? What's the B part? You should, the C part, any factors that the directors and shareholders of both companies might consider in assessing the acceptability of the proposed takeover. They can look at the future, they can look at future growth potential. They can look at, okay, let me write it. You people should, okay, let me see if I can write it also. But you people go and explain it by yourself. Oh. You people go and explain it by yourself. So you say C. So you can say, what did I say earlier? I said they can look at the future.
Future growth potential.
Yes, they can look at the future growth potential. They can look at future growth potential. Another thing they can look at is they can look at the financial strength. Those are the things they will consider before they go and merge. You can look at the financial strength. The financial strength and maybe stability. You can also look at, but this one does not really, this one is partial, but I don't think we look at it in this part of the world. Impact on maybe employees and management. There can be regulatory and legal issues too sometimes.
Please, share your screen. Though, is the question that is coming up.
The question, okay.
It's your network, man.
Regulatory and legal issues might also come up. Sometimes, whenever there used to be tax implications. So, like, those are the things that they will consider before this proposed takeover. They will consider that is, if they face tax liabilities, are they going to sell? Are they going to sell at all? Are there better tax efficient ways to actually structure the deals? Those are the things they will consider. They will also consider if there are alternative bidders. Somebody is unmuted, please. They also consider if there are alternative bidders. So those are the things. You can also, this is just grammar. They also consider the reputation and brand value. So I think this is okay. I think this is fine. So these are the things that would be that they would consider for what's the name? For the takeover. Please, is this fine? Yes, it is fine. Oh yeah. Let's continue. So the last one, the D part of the question. Is it good? I'll give me that one. What's the D part of this question? What's it saying? Somebody help me with the D part, please.
List any 5 defensive tactics that can be used by Queen PLC to frustrate the takeover bid of Kings PLC.
Yeah, Mungbo.
Poison tactic or
poison pill.
People's pill.
Green pill,
Black Knight.
Poison pill.
Poison pill, Dark Knight. Bro. I cannot hear you people.
Crown Jewel.
People's Pill.
I've heard poison pill. I've heard sandbag. I've heard green pill. We have
That's
magnetic. We have
nice.
eh?
White Mind.
Macaroni.
Counterfeit.
Saturday night special.
Saturday night special. Eti Kawi. So that one too. But like everything is in that previous material, is in one of those materials I've sent. But let me roll it through for people that have never seen it before. So we have what we call green meal. We have green meal. We have people peel. We have poison peel. We have macaroni defense. We have white knight. We have sandbag. All those things. So those are some of the ones. Please know how to explain them. Don't just go and list for icon. How many marks is it? 5 marks. So don't just list 5 and move on. No. Like this is icon, it's a professional exam. Don't his list that is in the question, fine. His list, but explain. We call it 2FA, two-factor authentication. Explain. Why am I telling you to list and why am I telling you to explain? You don't necessarily need to write a full, it can just be 2 lines or 3 lines. Just 2 lines and move on. Why? There's no negative marking. If you explain, if you know it, will fine. But if you don't know the explanation, you're fine. You can just list and move on. But what I'm saying is, if you can write 2 lines on each and every one of them, it's fine. Because assuming that, okay, now they want to check list is kuku there. If they don't want the explanation, they should help you and leave it. You get, they should leave it if they don't want it. But for the what's the name? If they want the listing, it's there. So, and sometimes, let's say you get 45, 46, 47. Sometimes the examiner might want to look for maybe where to add marks for you or just to help you. But some of those explanations just shows that, okay, this person actually knows some of these things. I'm just saying, then it happens, it can just free you. Then you will just move on. So please list and try to read the explanations. I think I kept those explanations in that exact material also. So I think that works. Please and please, class, I'm going to need you guys to do something for me. I know you want to ask me a question based on that last thing I solved, which is very, very perfect for me. But according to our time, it's going to be a problem for me to, because I'm already saying about 3 million hand. About 3 million hand already up. So I'm sure if I ask that any question about another 3 million will join it. So to not allow, how would I say it? To not to maximize our time concerning this, write your questions down so that you will not forget. Write it down or put it in the chat box or anywhere so that you will not forget. So please let me solve question 2. So when I'm done with that one, I'm sure I will not take all the questions. You can always tell me, okay, go back to question 1. I hope that's fine. It's majorly because of time. I plan to solve three questions per class. And the way I'm looking at this time now, for me to solve 3 questions might be difficult. At least let me solve 2 at all. So please just write down the questions. I will come to it very, very soon. Please. Ejo. But since there are just 2 calculations there. So the first calculation, I think that was clear. I cleared all these questions. So it's just the second one. So don't worry, I would clear that one also too. Oh yeah, somebody need question 2 for me. Yeah, fast. Somebody with question 2 for me.
The directors of Argentina PLC, a conglomerate, is targeting Portugal PLC, an engineering machinery manufacturer, for possible acquisition of its entire share capital. They believe that the takeover will not affect their business risk. The statement of the financial position of Portugal PLC as at 31st December 2014 is expected to be as follows. Portugal PLC projected statement of financial position, all figures assumed to be correct. It summarized financial records of Portugal for 5 years is as follows. All figures assumed to be correct. Additional information. 1. There have been no changes in the issue share capital of Portugal PLC during the past 5 years. 2. The estimated values of Portugal PLC's non-current assets, inventory, and work in progress for the year ended 31st December 2014 will be as follows. We have replacement values and realizable values of non-current assets and WIP, inventory and work in progress. 3. It is expected that 2% of Portugal's PLC receivables at 31st December 2014 will become uncollectible. 4. The cost of capital of Argentina PLC is 9%. However, the shareholders of the company expect a minimum return of 12% per annum on their investment in the company. 5. The current PE ratio of Argentina PLC is 12. Companies within the industry having similar profit level with those of Portugal PLC have PE ratio of approximately 10, although these companies tend to be larger than Portugal PLC. You are required to A. Calculate the value of the total equity of Portugal PLC using each of the following method. I. Statement of financial position, that's net asset basis. II. Replacement cost. III. Realizable value. IV is Gordon's dividend growth model, and 5. PE ratio model. B. State one limitations of each method in A above. Total marks 20 marks. Thank you, sir.
Thank you very much, madam. Thank you very much. So, let me run you guys through again for people that have never been in any. This is still business valuation, but like I told you, or like I've explained to you guys, we have how many? We have how many methods of calculating business valuation? Let me just ask you people first. No, let me just ask.
3.
What are the methods?
3.
3.
Let me come also 3 for you.
5.
We have 5, but there are 3
5.
major ones.
5.
But there are 3 major ones. So you guys are still correct. There are 5, but there are 3 major ones actually. So I said we have asset-based method, we have income-based method, we have cash flow-based method, we have value-based method, and we have what? Option-based option-based method. Thank you. So for the asset-based method, we have we have 4 method, or we have 4 bases that we use for that one. So we use our book value basis, we use our replacement basis, we use realization basis, and lastly we use liquidation basis. While for income based model, we use what? We use our earnings yield, we use PE ratio, or we use what? Dividend, or we use dividend yield for that one also. Good. So lastly, we have cash flow based method. So for cash flow based method, it could either be free cash flow to firm or free cash flow to what? Free cash flow to equity. So those are the only ones it could be. Those are the common 3 anyways. Then we have value based. For value based, we have your EVA, you have your shareholder value added also. We have economic value added, and we have shareholders value added. Then lastly, we have option based method. So those are the 5 methods. So usually it's asset based, income based, and cash flow based that are the popular ones. So if you are doing asset based, book value basis, I've told you guys before that for book value basis, just simply go to your financial position. There will always be financial position in the question. So just go to your financial position and subtract your current assets, or sorry, subtract your total assets from your total liabilities. Whatever you have, that is your book value basis. Please, are we together? Are we together?
Yes.
Are we together? Yes. Thank you. So I said go to your financial position, just carry your current asset, your total asset. What am I saying current asset? Carry your total assets, subtract it from your total liabilities. If it was me, I would just go to the question, then I would just pick my what's the name? I'll just pick my equity. It's still the same thing. I'll just pick my equity in the financial position. But for clarity's sake, please just go to subtract your total asset from your what? From your total liabilities. For replacement basis, they would give you information also for replacement value. it will be in the question. So whatever they say is changing for replacement, just carry the figure, go and put it there. What I'm saying is, in your balance sheet, they will give you replacement that, okay, non-current assets 5,000, receivable 2,000. Just take that figure. You are going to use it to replace what is in the balance sheet. Then get your new total assets. Then get your new total asset. Same thing for realization. Same thing for what? For liquidation. So this question now, I'll use it to portray what I'm trying to say. Therefore, income base, we have earnings yield, we have P ratio, we have dividend yield. The formula is still the same thing. Somebody's unmuted now. Lucky, please help me with your mic, please. So, like I was saying, then for the earnings, the formulas are still the same thing. The only formula that is different is your price earnings ratio. Because for your price earnings ratio now, they will always give you a PE ratio. They always give you a PE ratio in the question. So just multiply your PE ratio by the what? By the earnings. But usually you do adjusted earnings. Anybody that's been in my class, I've solved the question like that before. Usually you do adjusted earnings. So just do adjusted earnings and now multiply by the PE ratio given to you in the question. Lobaton. That's that. For free cash flow, there's a format to it. There's a format to your free cash flow. Just use that for your free cash flow to firm, or if it's free cash flow to equity, use the format for it. Oh yeah, but according to this question, let's solve it according to what they said we should do in this question. So let's start from the first one, which is the book value basis. So let me go to the question again. So they said, what's the name of the company? Argentina, Abi? Argentina PLC. So calculate total equity. You're using net asset basis. Okay. So you see, so come here. So say Argentina PLC. Abi. So say calculation of total value. Of total value. So say A, net asset basis. Abi? So I said you will do your total assets minus the what? Your total liabilities. Yeah, what our total assets in the question? Oh yeah.
2,070,000.
2 million
70,600.
70,600. What are our total liabilities?
1,616,500.
1,616,500. What do I have?
454,100.
For what?
454,100.
Oh. That's why it's one mark. So like I was telling you the other time, so if it was me, because I know what I'm doing, I will just come here. I will just pick this figure. That means that thing you gave me is not correct. It's 454,100. Was that what you gave me? Okay. So I'll just come here. I'll just pick this figure. It's usually your equity. Most times, it's usually your equity. But please, just do it the exact way I did it. Please, do it the exact way I did it. It's just for presentation. Just for presentation's sake. Just for presentation, so that we will not just go and pick a figure. Somebody will just go there and go and write 454,100. Nothing to show for it. Please, just do it the exact way I did. And don't forget, I was mentioning something to you that time. That the figures, if you are supposed to do realization, or if you are supposed to do replacement, they will give you the figures also for something. See exactly what I'm saying here. See, they gave you replacement value. So what it means is your non-current asset is changing by 725, then your inventory is changing by 550. So carry this 725, come and use it to replace this non-current here. Bam, use it to replace this thing here. Carry your, what's the name? Carry your inventory, go and use it to replace that inventory that is there. Please, is it clear?
No, sir. Please repeat what you just said.
Yes, sir.
So what I'm saying is, you know that they gave you a replacement value here. Instead of you using this exact figure as it is here, just change your non-current asset, this 651, change it to 721, change this inventory to that one they give you, Lobaton, then do your total asset minus your total liabilities. The value will change. Then that is the new value. So to give
Yes, sir.
yeah, let me solve it. When I do it, I'm sure people will see. You will see what I'm talking about. Sorry, 1 minute, please. 1 minute, 1 minute. Please let me take my charger laptop. 1 minute though. Oh yeah. So let me carry all this. Let me take all these figures somewhere. So so you now come here and say. So let me say B now. So say realizable. You say realizable value. Abi. So let's say
Replacement cost.
sorry replacement. Replacement value. So you now say so you say non-current asset. Oh. What's the new value? What's the new value?
725.
725,000. Our current assets now. Think we have inventory. What's the value of the inventory?
550.
515, 900.
550.
That's the new value.
550.
It's a new value now. It's 550. It has changed now. Do you understand what I'm saying? It's replacements now. So what they are saying is change the figures in your book by these figures that are here. That's why they are here. So go and change your inventory and WIP to 550,000. That's what that thing is telling you to do. So you now come here, say 550. They don't carry light up. Voila. Oh yeah. After inventory, what do I have again?
Have receivables.
Receivables.
745,000.
So it's only the ones that ask you to change that you change. Leave the rest. 745,000. Listen, cool.
Bank overdraft.
Bank overdraft.
158, 100.
158.
100.
Now.
Yeah.
Yes.
What do I have? Sorry, let me write
2,178,100.
What's the total of this one? In the shape of gone.
1,453,100.
1,453,100. So total of all is what?
2,178,100.
178,100.
So that's our total assets. So let's do our liabilities now. We only have how many liabilities?
2.
So,
Payables and bank overdraft.
so liabilities. So you say receivables. Sorry,
Payables.
receivables. Okay. You say payables. How much?
753,600.
753.
600.
Next one.
Bank overdraft.
Bank overdraft.
862,900.
862,900.
Total 1,616,000.
1,616,000.
500.
Sorry, 500. So what do I have? I need to subtracting this one now.
561,600.
561,500.
So you can now say your total value is equals to what?
61,500.
61,600.
600.
61,600.
600.
600.
So this is the total value using replacement value. Yeah, you should try the last one too. I mean the what was the last one? The third one. Realizable. Yeah, try it. Let me just be sure you know understand what I'm doing. But the problem with the realizable is, they gave you figures, but the thing is, if you look at the figures given to you, you have your non-current assets, you have your inventory and work in progress. At some point, they now said that it is expected that 2% of Portugal's receivables at 31st December will be uncollectible. Now, what that means is, once you are doing your realizable value, reduce the receivables by 2%. That's the meaning now. It will be uncollectible. And I'm sure what is in your e-book's mind is, why am I using it for realizable, not replacement? What replacement value means is that, listen, what replacement value means is, or whenever you're using replacement basis, what it means is, if I go to the, how would I say it now? If I go to the market, okay, now this is my laptop that I'm using. If I go to the market, say that I want to replace this particular laptop, what is the current price? I'm trying to replace it. What is the price? That is what using realizable value. I'm just using, that's what using realizable value. That's what using replacement, because you are trying to replace it. You are trying to replace this laptop now. So you're trying to, I'm talking about replacement now. Sorry, or not realizable. Replacement. Listen, it's replacement, not realizable. Replacement means, okay, I want to change my laptop. My laptop is old. Let me take it let me go to the market. How much would I buy something exactly like this? That's what replacement is. But realizable is simply saying that, God, at all, if I want to sell this my laptop, how much will I realize from it? I don't know if that grammar is clear. For replacement, you are using the current market value. If I want to, but the amount I will realize for me does not necessarily mean current market value now. Ladies, I'm sure people know this thing. If I want to sell this my laptop now, I take it to the market. It's not my laptop that is going. I'm just using it to know the current price. That, okay, how much are they going to be selling a laptop like this? That is the replacement value. But for realizable is simply saying that, how much can I get from it? How much can I get from it is different from the market value. It's different now. So whenever you see something like this, it's expected that just remove it from the realizable. That's what I'm saying. Don't touch the replacement. That's why I did not remove it from my replacement value. Don't touch the replacement. Just remove it from the realizable value. So you can do it two ways. You can subtract it from the realizable. You can subtract it from the receivables. Sorry, subtract it from the receivables. But please be very, very, like I used to tell you, let your presentation skills make sense. so that it's clear. Yeah, let me do it for you. So going to woo me here. But what, people that have done it, what do you have? If anybody has done it, anyways.
291,700.
291,700.
291,700. So what I'm saying is, so let me come here. So you just see realizable value. So our non-current asset is what?
450,000.
450,000. Our inventory is what?
570.
570.
570, like this.
Yes.
Now, what some of you would have done is you would have charged the 2% on these receivables before bringing this figure, which is very correct. But what I'm telling you is, please be very, very be articulate. Yes, be articulate. You could come here, say you can do 2% of 745, but show it in your book that you are subtracting that 2%. Don't just assume examiner will know. What if he doesn't know? I'm sure he knows, but don't just assume. That's what I'm saying. So show it somewhere. What's 2% of this thing?
14,000.
No, 14,700. Like this?
14,900.
900.
14,900. So you can do it this way, or with me, I would not like this way. I would not like you because I've been coming with positive since now. I'm just coming, I'm just subtracting. But this still works. But for me, this is the way me I would do it for my own stuff. So you do something like this, your liability still be the same thing. So what do I okay, sorry, what do I have here? What do I have here now? Still using the exact 745.
745.
Go.
Yeah, the
1,458,200.
1,458,458 what?
No, 1,473,100.
473.1, please. 1,473,100.
473,100. Yes.
So my total is now what?
1923. That's 1,923,100.
So
Are we not expected to deduct that 14,900 from the 745?
It's still expired.
It's still the same grammar I'm saying now. That you can do it anyway. You could have removed it from here, but me, I don't want to remove it from there. You can remove it from this under here, but me, I don't want to remove it from here. Just watch out what I will do. So this is still the same thing. What do I have as my final answer?
291,700.
290. You cannot have 290 now. You know, I've not subtracted my
306,600.
306,600. So you now come here. You now say less 2%. I'm just saying you could do it either ways. It's just me. I don't want to put minus here because I feel like my asset now. I've been coming with positive. An asset is, if for a good company, your asset is supposed to be positive. For me to not just come and put negative out of anywhere, it does not make sense. And another thing you could have done, I'm just giving you ways that you could have done. Another thing you could have done is you could do 2% of it in your workings. Do you get? So whatever answer you get, come and bring it in. Now put bracket workings 1, workings 2 here. You can do it like that. Just make sure that it's showing somewhere that you actually accounted. What I'm trying to let you avoid is some people in your head, you just do 2% of this 745. Then that's the figure you will bring here. Then you will not write it anywhere that's what you did. Those are places where you lose marks, please. So let's 2% of 745,000. What do I have? 14,
900.
So what's my total value now?
Two nine one seven hundred.
291,700. Thank you very much. So that's that for that. So the third one. I mean, the photo, what was it telling us to do? There's a fourth one.
Dividend growth model.
Gordon's dividend growth model.
So for people that don't know, Gordon's is actually Gordon's. Listen, you know that if you guys listen very well, you know that when I was mentioning the method to what's the name now, the method to value a business, I never mentioned Gordon's. I mentioned most of Gordon's for you. I did not mention Gordon's now. It's because Gordon's is not particularly, or it is not a valuation model. But what the question wants us to use, the question actually wants us to use what's the name, dividend valuation. But there is no growth in the question, and it wants us to use Gordon's growth to just calculate the growth before using our dividend valuation. Basically, that's what we are supposed to do. But we need Gordon's dividend growth to just calculate growth. That's just. So what's Gordon's growth? What's formula for Gordon's growth?
R times B.
R
Which is
times
equals
B.
to R times
B.
What's my R?
your return.
My kidney.
Investment. 12%.
Return on investment.
12%.
That's what I'm asking. What is the meaning of R?
Return on capital employed.
Retention.
Return on capital employed.
That is my problem. I mean returns on clinical, I mean retention, I mean a lot of things.
Return on capital employed.
That's my hierarchy.
Yes.
Return on investment.
It's retention.
It's return on investment. ROI.
How is your return on investment?
Retention is B.
Retention, B is retention.
B is retention.
R is your rate of return, your return on investment, your cost of
return on investment.
Any grammar you want to blow it. Any grammar you want to blow it. It's not retention, it's B that is retention. A lot of people are unmuted, which I do not like. If you have answered me, mute yourself back, I beg, so that we can have a peaceful class. Anyways, so that's for that. So consistency gurus everywhere. God, I beg, go. You get there too. You'll get there. So now for R, which is our rate of, let me write it for you, bro. So you say R, which is our rate of return, or return on investment. B is our what? Retention rate. So if you are supposed to calculate our rate of return, which is our cost of equity, depending on the question, most questions or some questions will give it to you. But it's not if it was not given to you, use your normal way of finding your cost of equity. Use it to determine it. You can use your dividend valuation method. Now let me ask you guys a question. I like to ask this question a lot. Do you know that, or no? If you want to use, okay, let me ask again. If you want to use, this is a revision class, so these are some of the revision. If you want to use dividend valuation to determine cost of equity, how would you do? What's the formula you will use? If you want to use dividend valuation to determine cost of equity, what's the formula you will use?
Dividend over, that's D over PO.
I'm coming.
Dividend over
I'm coming. Let me write it. Thank you, sir. I like the energy. So you are saying cost of equity is equals to Mungo dividend
over market price. X market price.
X market value.
Market value X dividend. Market value.
Plus growth.
Like this, I mean?
This is the normal formula. I said there's growth.
Sorry,
Please,
sir.
where
Well,
dividend is
D
constant.
is D into 1 plus G
into
over
1
R
plus G.
minus G.
Please calm down, please. Hey, the madam that talked to me last.
Yeah,
Are you,
D
are you
is
want to give
D
the correct
into
answer?
1 plus G over R minus G.
Thank you very much, madam. Is your husband you will marry? R minus G.
So this question is when there is growth, right?
That's the question.
Okay.
Or when there's good. That's what I'm trying to get. So now, madam that gave me this formula. God, I beg. You see that
Sorry,
SFM is very sweet. Please just listen to me. SFM is very, very sweet. I said we are trying to determine cost of equity. We are trying to get R. That's the formula I'm asking to get using this formula. But you are still giving me R inside here now. How this formula
sorry,
won't
sir.
come
I
to
have a
play?
different version. I have a different view, sir.
Oh,
Sorry, I
please,
have the formula.
hold on with your view and listen to me now. Just listen to me first. I'm not saying this is the correct answer. I'm just explaining what she told me so that she knows what she said wrong, so that she will not make the mistake again. My question was, if you want to use dividend valuation to get cost of equity, what would have been your formula? You're trying to get cost of equity. R here is the cost of equity, gongo, or your rate of return, anyone you want to call it. How are you now? What you're trying to get is still here. It's twice now. So this formula will not work. Like,
Can I give you another formula, sir?
I'm listening.
So that place she put over, no, DO in bracket 1 minus and plus G. Over market value plus growth.
The market value.
That is MV.
ST.
Then plus.
Like this.
No,
ST.
the plus will not be, for me, I don't normally put plus on that. Just plus GS.
This is the correct formula now.
Yes.
This is the correct one. Now, the thing is, you know that one that we wrote earlier, which is our cost of equity minus growth, is just that's if you want to get market value. This thing is the same thing. If you cross multiply and you do all those things, and you make R subject or formula, you get something like this. This is what I'm saying. Some of you will be looking at me with bad eye, like, what is this not saying? What I'm saying is, this thing here, if you do something like this, it's a revision class. We are revising. You do something like this, KE minus G. This thing that is under here, that's where this formula up here is derived from. Now, if you cross your multiply and you make KE subject or formula, you're trying to make KE subject or formula, it gives you this exact thing back. People that went to Namina U, that did not go to good school. People that went to good school, if you do it very well, you will get something like this. So this is where the formula was derived from. Please, if you have any question regarding this one I just explained, ask me now, fast. Fast. No question. Thank you.
Please,
I have a question, sir. Sorry. I'm trying to raise up my hand. Okay, my question now is, at what point will I use this formula? KE is equal to D into 1 plus G over market
You're trying
value.
to get cost of equity now. If you're trying to get your R.
Okay, then I'll now use the other one when I'm trying to get market value.
Yes, if you're trying to get market value.
All right, thank you, sir.
You're welcome. For this part, but this question, that's not what we are doing. I just branched a little new. It's revision. We are revising everything in general. So I just branched a little, but this is not what we are doing here. I think our R was given to us in the question. So I don't think we need to do that. So retention rate, what's the formula for retention rate? Mungo.
Current earnings minus current dividend divided by your current earnings.
Profit
Current
after tax
earnings.
capital employed.
Your current earnings
Current earnings
minus your current dividend by your current earnings.
So your earnings minus your dividend over earnings, correct? But I don't like to use that formula for me. So I like to use my 1 minus that one that you know. Try what I want to do. That's what I always tell people. I've seen some of you send me answers and some of you cram the Pathfinder. Oh, no, that's not the way to learn. There's a way you know it. There's a way I know it. Fine. This formula I want to give you is different from the one you know. But that one you know, try it on this question. It will give you the same answer. It will give you the same answer. So your dividend payout ratio will now be what? That thing that Madam said. Your dividend per share over your what? Over your earnings per share. If you look at itself, it's almost the same thing. Dividend per share over earnings per share. So you can use this. You can use that earnings minus earnings per share over dividend per share. You can use that one also. Anyone that's comfortable for you. So according to our question, what are our according to the question?
12%.
2. What's our R in this question?
9%. 9%.
Good. Good. What is the meaning of R first? Let me start from there.
12%.
Cost of equity.
Yeah, but you're saying cost of capital here, and you're still calling 9%.
Sorry.
Or let me ask you guys a question. Is cost of capital the same thing? Listen, no, is cost of capital the same thing with cost of equity? I'm asking the class.
No.
12%. No, sir.
Cost of capital is different from cost of equity now. Cost of capital is the cost of the entire, but plus equity, plus debt, plus everything. But equity is just cost of equity, just equity. But this cost of capital now would have comprised debt, preference shares, and all those things. So please, that formula is our cost of equity, our R, not cost of capital, please. You say your R equals 12%. Okay, let's do our B now. Let's do our B. So you say B equals to 1 minus, what's our dividend in the question? Last year, please.
25,000.
25,000. What's my earnings?
$52,200.
Please don't give me any.
52,200.
Please don't give me. Please don't give me earnings after extraordinary item. Nothing like extraordinary item. So give me before extraordinary.
52,200.
Before extraordinary item.
53,200.
3.
I just told you.
53,200.
53,200. 53,200.
Thank you. Give me before extraordinary item, not after. So what do I have?
53% times 100 over 1. 53%.
So let me use 0.53. No. It's the same thing as 53%.
Yes, sir.
Or for clarity's sake, let me just say 53%. Since my R was already in 12%. So you now come here and say your G equals to your R times B. G equals to R times B. So G therefore equals to
So your screen is not moving.
not moving, K. Screen is moving. 53% multiplied by 12%. What do I have?
6%.
6%. Now, for this question, these are our growth rate. But like I always told you people, SFM is dynamic. You know, me, I will always say it. SFM is very dynamic. The way I used this last year is because I like simple things. I don't like things that will complicate my life. You can see in some books, or you can see in some people, or some lecturers can come to you and they will use average. Average will still work. Average will still give you the same thing. I don't just like stress. So they will take all of them, they will take all the years, they will now divide it by 5. I don't get all those energy. So I'll just pick last year. The two assumption works. You can either use average. I'm talking about the dividend. This is what I'm talking about. You see this thing I did. This what's the name? This B that I did here, that's what I'm saying that some people can use. They can use average, and you still get the same 53%. So some people can now be taking, so they will take their dividend. So they will take dividend divided by this profit before extraordinary, take this divided by this, 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 add everything together. They will now divide it by 5. You will still give you 53%. And we still give 53%. But I don't like stress for my life. Since the two assumption works, you can assume that you want to use final year, or you can assume that you want to take average. The two assumptions is allowed. So me, I'm just taking final year. Thank you very much. So yeah. So now that we've gotten our growth rates now, so now let's go and use this to determine our market value. So you now say market value. What was that formula that madam cooked for me that time? So no, I should have not deleted it.
DO in bracket
DO equal 1 plus G over R minus G.
No, over market value.
Market value K.
Over KE.
Sorry, KE
over KE minus G.
KE minus G, sorry.
Or R minus G. Okay. No, KE minus G.
So you can use R, you can use KE, anyone works. It's the same thing they are blowing. So let me copy this. I'm already tired. So what's our due? What's our dividend? I think we use 25,000 now. Abi?
Yes, sir.
1 plus.
Yes, sir, 25,000.
0.06. What's our R? We said it's 0.0. 0.12, Abi?
Yes, sir.
Minus 0.06. So what do I have?
$441,667.
Correct. 441,667.
667. So this is what they wanted you to do. The last one. I think the last one is written. The E, which is your
P ratio.
PE ratio model. Now let me explain something to you with PE ratios. You know, I told you that most times you always adjust your earnings, yeah? But the thing is, what me I've noticed over the time when it comes to PE ratio is that most times the company, like our own company, is usually listed. Listen, they are usually listed. When I mean a company is listed, it means their stocks have been sold on the stock exchange or stock market. Now, our own company is always very listed. Now, if you don't want to acquire, you want to acquire another company. So in the grammar of the story, I'm just saying from experience. So in the grammar of the story, they will now tell you that, okay, the company you want to go and acquire, listen, they tell you the company you want to go and acquire, this is their, maybe they don't have a PE ratio. They will now say, but there is another company. They will now say, but there's another company in that particular industry that is also not listed. That is also not listed. Or even the company you want to even acquire can even be listed. Let's say this one now, Argentina wants to acquire Portugal. Argentina can be listed. Portugal can also be listed. They will now say that Portugal, particularly now, does not have a PE ratio. But there's also another company, say maybe Nigeria, that is in the same industry with Portugal, but they are not listed. They will not give you those ones. They will give you their PE ratio for those ones. Now, what I is trying to tell you there is that a company listed and a company that is not listed, they can never have the same PE ratio. They can never have the same PE ratio. What it means is a company that is not listed, they have, what is the name? They have higher risk. If your company is not listed on the stock market, you have higher risk. So you have a lower PE ratio. That's the meaning. If you have higher risk, you must have a lower PE ratio. So a company that is not listed, so you cannot use that particular PE ratio that was given to you in that scenario. for that question, because the one that is given to you, the company that is given to you, the PE ratio, they are not listed. The company you want to use it to value, they are listed. So it cannot work. What do you now do? SFM has allowed us, they have given us permission to take 70 to 90%, or within 70 to 99% of the PE ratio of those companies. So what you're trying to do is you're trying to account for the risk. Bad grammar, meal. You're just trying to account for the risk of them not being listed. That's just what you're trying to account for. Let me see this grammar of this story now. See this. I don't think there's anything like this in this story, anyways. And another thing is, before I even read the story, and another thing is, normally, if your PE ratio, if you are not using your own exact PE ratio, listen to me. If you are not using your own exact PE ratio, if it's another company's PE ratio, don't use the PE ratio like that. Account for risk. So I said SFM has not allowed us to take within 70% to 99% of that PE ratio. So you can do 0.80, you can do 0. I used to advise my students, do what? Do 85%. Use it 5%, because 5% is still in the middle. Don't worry, nobody will penalize you. Just when you are done, just go and write your assumption. See this question now. Directors of Kinikon, blah, 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 blah. So they now came here. I'm trying to look for where the PE ratio information is. See, listen, they said the current PE ratio of Argentina PLC is 10, is 12, fine. Companies within the, it's Argentina that wants to acquire now, so we don't need PE ratio of Argentina. We are not valuing Argentina, we are valuing what? Portugal. So you now come here and say, they say companies within the industry have similar profit level with those of Portugal. Companies within the industry, they have similar profit level with those of Portugal, and they have PE ratio of approximately 10. Although these companies tend to be larger than Portugal PLC. You see this line? Although what is just telling you is don't use exactly 10%. They did not use listed and unlisted here. And that's why I told you the companies are always very dynamic. Now they take like under the setup. So they did not use listed and unlisted here. But they said although these companies tend to be larger than Portugal. So what they are saying is there are other companies, Nigeria, Belgium, but they are bigger and their own PE ratio is 10. Since they are bigger than it automatically means that Portugal's PE ratio will be smaller now. Do you understand? It means that their PE ratio will be smaller, but you cannot decide. So, like I said, SFM has not allowed us to take within 70% to 99% of this 10. But you cannot say you are accounting for something that you are taking 99%. It's too much. 70% is too small. So I always just tell myself, just stay in the middle, take 85. JJ, just take 85%. So you take 85% of 10, then you have accounted for their risk of not being as large as this Portugal PLC. So you just take maybe 5% of it, then you work with it. Is that fine? Edamilo.
Yes.
Edamilo means answer me.
Yes.
Hey,
We are trying
to.
As I teach you now, SFM, I will teach you now Yoruba too.
Oh my God, sir. Oh my God.
You people don't. I used to tell people now that Yoruba is the language of God. That's the language that God will use to judge us in heaven.
Nibo, no riro.
Is it people that don't want to believe now?
No riro.
The first question is, do you understand Yoruba? If no, that one is between you and God, sha. No, me good talk. Let's continue. Let's continue. So this is the formula. You multiply your price earnings ratio, the ratio that is given to you, multiplied by the earnings. But for this particular question, there was no adjustment to our earnings. That's why this question is still better. In some other question, they would have told you, can it happen to their inventory? Maybe their inventory was not valued properly. Say, can it there was mistake in their balance sheet. You can adjust all those earnings. But in this question, we don't have anything like that, so we can just move right straight up. So, like I said, just take 0.85. That's 85%. So you take 85% multiplied by 10. That's our PE ratio. What do I have? 8.5.
8.5.
8.5.
So what you've done now is you have, since these the people that are bigger than it, their own P ratio is 10, times our own P ratio is 8.5, so it's lower. Somebody could use 70% and it will still work. Another person will, people will get different answers. Yes, now. But write your assumptions when you are done. I was assumed that the 85% was assumed because other companies in the industry, they are bigger or they are larger than Portugal PLC. So it was assumed that they will have a smaller PE ratio. So you now come here and say 8.5 multiplied by what's our earnings again? What's our earnings again?
53,200.
53,200.
53,200.
So what do I have?
45 to 20.
45K. This is 53,200. Now we'll have 45.
45 to 200.
45 to 200. Lobaton. Lobaton. Limitation of each above. So tell me those limitations now. What are the limitations? I'm listening now. I've told you people before now. What's the limitation of book value basis?
It's based
It
on
doesn't give a true picture of the value of the assets.
It does not
It
depict the
doesn't
true value of the company, nor of the asset. Though. It does not depict
of the
the true
company
value
because it doesn't take
of the.
time value of
Because I know
money.
that this thing now, is for book value. You are just looking at balance sheet. Now balance sheet items are from years previous, years ahead. So it does not necessarily say
Historical
where we are
figures.
as an organization. It also uses historical basis. It also uses. I hope somebody is jotting them down. I know the right time. I'm tired. So he also uses historical basis. He uses historical basis of valuation. He uses historical basis is balance sheet now. So I've given you two. The next one, there was also one there. People will go and do this one by yourself. For dividend growth, that one you cannot work for companies that don't pay dividends because that's for growth model. Because they are paying kidney now. There's growth there. You cannot work for companies that don't pay.
Now, not which one, third company.
But I cannot hear you.
Yes, it's what I said that you repeated. Sir.
I still cannot hear you. Cannot hear you. Yeah.
Said what she said.
It's the same thing we are saying, sir.
Okay.
Cannot work for companies that doesn't pay dividend.
Yes. So, Ewoloku,
We have the PE ratio model.
PE ratio method. PE ratio method also, you know that it's always very difficult to get, how would I say, the assumptions is actually too much because of, what I'm saying is it's difficult to get PE ratio of a company of the same size. The same size, it's difficult to get PE ratio of companies of the same size. So that's that one for that. For Ewotoni, for realizable, you can say he ignores going concern. He ignores going concern.
Replacements.
Huh?
Replacements.
Replacement too.
Can we say
That one too does not. That one too ignores going concern anyways, and he also ignores future earnings because you are replacing, you are changing them now. So he ignores what's the name? He ignores future earnings or future earnings potential. Okay. He ignores future earnings potential.
Does not consider time value of money. So it does not consider time value of money.
It does not consider time value of money. Oyinbo, you know, Ani?
No, I think that one will work for the net book value.
For the net book value, yes.
Yeah.
Will work for the net book value. I'm thinking of something. I don't know how to go about it, but anyways, let me see. Let me read something. I have 2 minutes. Tomorrow is Sunday now. We are not going to church. We are not going to
What
church.
are you going to do for people that are going to work tomorrow? Azam.
I'm saying you are not supposed to go to church. You want to they go work. At this period, is not
Go to church.
And they go work.
that won't concern you. You people use my time also now. You people use my time for what's the name? See, make a revenge. I'm trying to see if I can solve this question 3. If it's not too much. Let me read it. Blah 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 blah. Just look at flow now. It's not
I
plenty,
thought
Sha.
you
You
said
guys.
you're tired.
Please, we are tired since 4 p.m.
Me, I get people don't know me. I get bastard energy. My tired is just mouth. I can day every day till one. But let me solve. I get energy die.
Story.
Every day till one.
Jesus, Jesus.
If people are willing, I am here. Please let me solve this question 3 real quick so that
Yes, the
why
question
don't
3, sir.
Carry
why
on,
don't solve
sir.
it? Hold on.
Sir, it's almost time.
Hold on now.
So,
Hold on.
question 3, oh.
It's only 1
Hold on.
minute
Hold
to.
on.
It's
One house.
almost
One house. One
time.
house.
Fire on, fire on, fire on.
One house. So wala in po. God of mercy. I don't dey. You add into my stress. Hold on. The reason I want to solve this question 3 is this question 4 is actually a lot. Like I mean, it's actually a lot. I mean, looking at it like this, it's forecasting. And forecasting questions, I don't. They are always so stressful. So it will take a lot of our time in next class. So let's finish this one. So know that we are done. We are starting from question 4 in our next class. No, just give me 10 minutes. 10 minutes is small. But give me 15 minutes. I'm supposed to finish in 15 minutes. So yeah, question. It's not people that are supposed to be begging me, self. That sir, please solve.
Carry
Please.
on, sir. Carry
All
on,
right.
sir.
Just give me a few minutes. I will soon be done. So this question is very sweet. Somebody read the question. Let me read it so that I will be fast at it. So I'm on it. This one is plenty for me to read. I'll be skipping some part anyways, but it's too much. So I said Jalingo PLC, they are called JP, repairs and maintain every duty trucks. We workshops all over Nigeria and the country, the number of countries in Africa, all the figures there, I wrote them by myself, so I assume they are correct. The free cash flow to equity is currently estimated at 153 million. It's expected to go 2.5 per annum to infinity. Okay. The equity shareholders return, they require a return of 11%. And I love this question. I think I've seen this question somewhere before. The company's non-current liabilities consist of 1,000 nominal value of bond, which are redeemed in 4 years at par, with a coupon rate. Okay. With a coupon interest rate of 5.4. Okay, this one has bond valuation in it. The debt is rated BB, and the credit spread on BB rated debt is 80 basis points above the risk-free rate of return. All these ones are grammar. The government, blah blah blah. The program will involve massive. I don't know, concern me. The project will cease after 4 years because of increasing competition. The initial cost of the project is 84 million, expected to be 4 years. These are the 4 years cash flow. The above figures are estimated on GBTL program going as expected. However, it's expected that there is 25% probability that GBTL program will not go as expected in the first year. If this happens, then the present value of future cash flow will be all these informations. I don't really need them for anything. I don't move on. Abaco, you can be reading it by yourself, but I don't need all those information for my solution. Abaco PLC is a listed company. That's the proxy company. Fine. It offers maintenance and related service for construction, mining, and agricultural equipment. Okay. Don't forget that this particular company is an agricultural company. Sorry, not agriculture, they repair and they maintain. That's what they do. They don't do agriculture. They do repair and maintenance. But this is our new proxy company now. See what they do. They offer maintenance and related service for construction, mining, and agricultural equipment. He now said about 15% of his business is in the equipment maintenance service. Maintenance service in the agricultural sector. But AP has an equity beta of 1.6. It is estimated that asset beta of non-agricultural maintenance sector is 0.8. So they have agricultural sector and they have non-agricultural sector. The agricultural sector, yeah, or the non-agricultural sector is the one that we want to consider, but we'll still consider the two anyways. So moving on, their shares are trading at this, and their debt are trading at this also. He has 18 million shares in issues. The book value of his debt beta is 0. This is their tax rate, the risk-free, the market premium. You have to calculate the current total value of TP, the equity, and the bond. Oh yeah, let's start. So this equity now, according to this question, they've given you free cash flow. I saw free cash flow somewhere. See, they've given you free cash flow to equity. So now, for the madam that was asking, I think it was Miss Diana, I cannot remember the person that was asking that, how do I know the one to use? For this one, they've given you free cash flow or something. Let me give you another expo. People know I like expo. If you want to know the one to use sometimes, listen, no. Somebody's omitted, listen to me. If you want to know the method, whether it's dividend valuation, earnings, or something, watch out for the one that is growing. Check, bro. Watch out for the only problem you have is if there is no growth rate in the question, fine. Hey, you can now go and be checking the first step. But like, check if there is growth rate. If there is growth rate, check the one that is growing. What is growing is what you will use most times. So if you are seeing the question, say dividend is going out, that means you're supposed to use dividend valuation. If you say earnings is going to go, you use earnings valuation. If they say free cash flow to equity is going to go, use free cash flow to equity. But the problem is if there is no growth rate, you're not going to check information given to you. So this one is going at 2.5. So we know that we're supposed to use our free cash flow to what? Our free cash flow to equity. So you come here. But the good thing is they do not ask us to go and calculate the free cash flow to equity. They've given us by themselves. Good ICANN people. In some questions, they would have asked you to go and calculate free cash flow to equity. But this one, they gave it to us. So it's easier that way. So you come here. So what's the name of the company again? Taraba Jalingo then.
Jalingo PLC.
Jalingo PLC. So let's say, so you now say, yeah, is calculation.
I'm not seeing.
I'm not saying, I think it's your network call. Calculation of current, you can log out and log in again, but calculation of
Your
current
screen
market.
is not moving.
My screen is not killing.
It's moving here. I guess it's your network, please.
I've been using that network since now. So I've been using this. I've not changed anything, so I'm sure this can share. So I think it's your network. You say using free cash flow to equity, I mean. So what's the formula? We want to get market value using free cash flow to equity.
FCFE bracket 1 plus G all over cost of equity minus G.
God will bless you, madam. So you said
Please, it's Taraba PLC, not Jalingo. Jalingo
Amen.
Jalingo is Kituniva. It's Jalingo now. Which is number 3 we are doing? Oh, yeah.
It's Jalingo.
So you come here, you now say free cash flow to equity. 1 plus G. 1 plus G KE minus G. So that free cash flow to equity. They gave us in the question now.
153 million.
So let me just write 153. Say 153. What's my good rate?
2.5%.
0.025. This question is just testing bond valuation. It's majorly focusing on bond valuation. What's my cost of equity?
11%.
Check. I don't trust you people.
It's 11%.
It's 11. She's right.
11%.
Look at the front, like the very first part of the question.
Okay, they require it. Okay, I don't trust you. Before you go and cook what I don't like from minus here, sure. 0.025. What do I have?
One 845.
No, but this question just, I think, is majorly focusing on bond valuation. Not, I don't think it's free cash flow or anything. It's majorly bond valuation as focusing. Anyway, so B. So you say current market value of bond. So if you let me run through bond valuation. No. You put no bond valuation now. I don't bond valuation.
No.
Yeah. It's not. It's not something I can explain everything this night. But like bond valuation is just bond is like is a form of debt. It's a form of debt where we have the bondholder, we have the bond issuer. So somebody gives you like a certificate, can borrow you money. So there's usually what we call interest, or we call it coupon. There's what we call what's the name? Yield to maturity. Yes, we also have what we call yield to maturity, which is your cost of debt. What we call cost of debt or yield to maturity. We have what we call the redemption value. Redemption value is simply saying that okay, at the end of this, how much am I? What is my redemption value? How much am I redeeming this debt to be? So it can either be at premium, it can be at discount, or it can be at par. And I said, and the face value of a bond, face value, nominal value, is usually 100 or 1,000. It can either be 100 or it can be 1,000. The question would specify, or if the question is not specified, part of the information you will see. See this one now. I think they told you something about 1 minute.
It's up.
No, it's here.
1,000 nominal value.
So they said it's up to, but like they said, the debt is currently trading at 1,050 per 1,000. So I'm just saying, in case if this question is not there, if this line is not there, this one is the question is being very generous for this to be there. If this one is not there, just looking at this information that is trading at 105 per 1,000, so you know that the nominal value, the redemption value of the bond is 1,000. So now we have what we call cost of debt. So for bond valuation, there are three things that they can ask you majorly. Either they ask you to calculate the yield to maturity, which is also the cost of debt, or they ask you to calculate the current market value of the bond, or they ask you to calculate what? Your duration. Either they ask you to calculate the cost of debt, they ask you to calculate the current market value, or they ask you to calculate the duration. If you're calculating cost of debt is simply just your IRR, your internal rate of return. So you use your IRR, you use your coupon, you use your current market value, all those things. You get a particular NPV. You select another discount factor, get a negative NPV. Then all those things, you get your what? You put it into your IRR formula. Then you get your cost of debt or yield to maturity. Then current market value is simply just current market value. For current market value, it's just you discounting. It's just you discounting. How would I say it? It's just you when they say current market value of a bond, it's just you discounting the cash flow, basically. What are the cash flows in a bond? The interest and the redemption value, or the face value, or the nominal value. Those are the cash flows. The interest, that is, somebody's unmuted though. The interest, that is the amount that the person will be paying either yearly, monthly, annually ahead. Then the redemption value, which will be given to you. So the discounting of all of them is what gives you your current market value. Yeah. So you maybe so if your interest is 10 naira, so you use annuity now. So you do 10 naira annuity 1 to 5 years. Then the last year you discount somebody's unmuted. The last year you discount your face value. global term. That's how you get your current market value. Then for duration is another is somewhat different. We have two types of duration. We have Macaulay duration and we have modified duration. So please just check them out. Or when they send the material, I'll send them to you so you can cross-check that. But for this one, we are trying to calculate, but for this particular question, we are trying to calculate the current value of the bond. So let's bring out our variables first. So let's say I have my coupon. What's my coupon? What's my coupon? Coupon also means interest. Yes, it's coupon or
5.4%. 5.4%.
5.4. Then a little bit in mono. Okay, it's written here now with a coupon. This question is so nice. So sometimes this coupon, they will not write it here. They will take coupon rate or no. They will just come to maybe somewhere in the balance sheet. You will just see bond at 9%. They will not put the value here. That percent in front is the interest. Do you guys understand my grammar? What I'm saying is this question is being very generous for them to write it for you abstractly like that. In questions where it's not written, in the balance sheet, they will just put bond. They will put 9%. They will put the value here. That 9% is your coupon. Yeah, I hope it's clear, Sha. Anyways. So coupon is 5%. Coupon payment. You know, interest is even on interest payment. Interest is the percentage. Well, now how much am I now going to be paying?
54.
540.
G54 is 540.
54.
So I'm expecting that you would have done 5.54% multiplied by 1,000. That's 54. My number of years, how many years is it?
4 years.
4 years. What's in there again? Redemption value. Redemption value. I think they said 1,000 now at par.
1,000 at par.
So what's my cost of debt? Eh?
Yes, sir. There's a place that poses a basis point of 80 basis points. I think, are we going to use it? Maybe we'll add it to the 5.4. Let me clarify on that part.
Am I going to add it to what?
The debt is rated PB and the credit spread on the PB rated is 80 basis points.
So what do I add it to?
No, I'm just confused of yes to use it, so I just need clarity before I.
Don't worry, we'll get there. So what is my cost of debt? Bagam.
Is that your other?
It's not in the question. It's not in the question, okay?
Is there 4%? Use the risk-free rate.
Is your risk-free rate?
4.8.
4.8. I won't come think though. Every
What is
second.
it? 4 plus that 80 basis points. 4.8.
So now the thing is, for people that don't understand what they are saying, for our cost of debt, normally we are supposed to have calculated it. That's why I told you that you use IRR. But for this question, they did not ask us to calculate. Don't set question for yourself. And they've given you your risk-free rate. Just go and use your risk-free rate. Risk-free rate you can also use your risk-free rate for your cost of debt, which is 4%. But they are saying 4.8 because you always add credit spread to your risk-free or to your risk-free or to your cost of debt. You always add, or to your yield to maturity, you always add credit spread. And if you read this question very well, they spoke about credit spread. They said the debt is rated BB and the credit spread is 80 basis points above the risk-free. Above. Sometimes they can say it's below. So below means you subtract it from 4. Above means you increase it a hair. So above the risk-free, 80 basis points. this is in basis point. It is not in credit spread. This is in so if you want to convert this 80, convert it to basis point. You divide it by what? Divide it by 100.
100.
So if you want to convert this to basis points, you divide 80 by 100. So if you divide it by 100, I think you have 0.8. Then it's at 0.8. You now go and add to what? You're going to add to this 4. Those are the things we've spoken about in bond valuation. So you say risk-free plus credit spread. So you now say that's 4% plus what? 0.80. So I have what? 4.8%. That's why I said this question just basically focused on bond valuation. So you come here. So we've not calculated our current value. We've got out all our variables. So you now say insert table. So let's go and do our discount. Let's discount our cash flows. Let's discount our cash flows. So if you come here, you say yeah. The late impossible. So you say yeah. You say items. Cash flow.
Cash flow, discounts, cash flow, discounted cash flow.
What's our discount factor?
It's going to be our redemption.
What's our discount factor?
4.8.
4.8%.
The present value.
That's our yield to maturity. Then you come here, you see your PV. So let me use annuity. So you say 1 to 4. You say interest. You say what's our interest? 54. So what's using annuity of 54 4 years? What do I have?
3.562.
3.562. Is it correct? Somebody check. Is it correct?
It's in 3.275 here.
Is somebody else cross check, please?
I'm having 3.
It's correct.
3.5. Correct.
3.562, Abi. So what's my PV?
Yes, sir.
$192.35.
192.35. So you have 4. Redemption. $1,000. Is annuity we use annuity too, Abi?
No, discount factor.
That was my discount.
0.829.
0.829. So what do I have in total? That should be about 829. So what's my PV?
1021.35.
1021.35. But this is not the total value. This is not the total value. This is just like you saying maybe value per share here. So this value per bond. There's nothing like value per bond. I just using that as an example. It's just like you say, when you say value per share, you need to go and multiply by the total number of shares to get the total value. So this one is just something like value per bond. That's what this is. So you need to go and get the total. So you're going to get the total market value. The total market value. So what's the value of the what's the grammar I want to use like this? Come here, let me look for
760. 760. Yeah.
Which is this one, Abi? The non-current liabilities, this figure here, Abi?
Yes, sir.
That's the value of the bond. I know some people might say it's not. Why didn't they write it abstractly bond? But like bond is a type of non-current liability. If they wanted something else, they would have put it there. But they did not put it. So just use the 07. Don't put 60. 60 is the current liability. This is the bond, 760. So you come here, you will now say 760 million multiplied by normally. Listen, normally I could have just multiplied it by 1,000. Like I could have multiplied, but like because of this my present value now, you cannot multiply it by 1,000 at all. So you now come here, you now say something like this. So you now say 1021.35 over a part. Which is low. And you tell me, people that don't want us to go, I mean people that wanted us to go. I do anything about. So I'm listening to you. So what do I have?
776.23.
776.23. 776.23. You see this question? You see that place that they said that is currently trading at 1,054 by 1,000. What it means is this. This is what it means, that currently that is the value of the bond. It's trading at 1,054 over 1,000. This is what you would have done. But you know what we will calculate now is we have discounted our cash flow. That 1,054 by 1,000 does not have discounted cash flow. So we've discounted our cash flow, all the money we are supposed. You know what you do with current value basically. What you do is these are the money you are supposed to make, but we are not in this year for yet. We are still in today now. That's what current value is today. Today's value. So we are still in today, but we know that okay, next year I'll make 54. Yet 2027 I'll make 54. 2028 I'll make 54. At the end, everything is 1,000. So I just pick all of all those 54, then discounted that particular value of the bond to know what I will have. So what this particular simply means is at the end, what this bond now, the present value that now this bond worth 1,020 and 21 instead of 1,054. It currently worth 1,021 based on this your own interest and your own redemption. That's just what that means. So you calculated total value by bond, total value on equity, Lobaton. That's what they wanted you to calculate. So next, B part. What's the B part of the question?
The risk-adjusted cost of capital required for the new project.
So calculation of the
risk-adjusted cost of capital.
Now,
required for the new project.
Sorry, it's not me that changed it to his word. So now, you know that if you want to do project specific cost of capital, Abi, what are the steps for project specific cost? What's the first step?
Get a proxy company.
You get a proxy company. After you get a proxy company, what do you do?
Remove the financial risk of the proxy company by ungearing.
If you are ungearing, whose information do you use?
The proxy company.
After ungearing,
you regear by imputing your company financial risk.
So you use your own company's information. After you've now regeared, uncle.
Solve for CAPEM.
You use it to solve for the cost of equity, then look for your work.
Using CAPEM, so you're not going to look for your work. So that's the first thing we'll do here also. So we'll get this gear. So let's say what's the name of our proxy company? I think Abaco,
Abaco PLC. ABPLC.
So say on gear the proxy company BA. Yeah, I said better. So come here now. So you say BA. What's formula to gear? Is equals to
BA is equals to
BE
BE
times VE.
VE over VE
all over
plus VD.
VE plus VD bracket 1
Plus
minus 2.
VD.
Network
Hello,
cards.
God understands the language that you are playing. So I just hear ED. God know what thing you did blow. Some people is only E they are saying. At least DE, that's the only thing they are saying. No wala. I can't be looking for calabash. So now say, so what's the value of the BE in the question? What's the equity beta?
You have to look for it.
We have to look for it, guys. They did not give us of the proxy company. They didn't give us the equity beta.
Combined business.
We have to look for it because
They gave us 1.6.
They gave us now. What are you looking for?
1.6.
They,
AP has
they
an
always
equity
give
beta
them.
of 1.6.
so they gave us percentage of industry of mining and then repair.
I have to look for it.
Madam, they said they have an equity beta of 1.6.
1.6.
Put it there. The only one, listen, the question is very, very straightforward. Only if you want to set question for yourself. They said AP has an equity beta of 1.6 given to you abstractly. The only percentage they gave you was about what's the name now? What's the name now? Which grammar I won't blow now? I'm on English to salo. Ochim. When I know the English I want to blow, I'll come back to it. But my English don't run now. So but they gave you the general equity beta, so use it like that. So times. So let's bring this here.
We are not to have a function.
But Miss Chika, I understand where you are coming from. But like, let me finish. You understand what I'm trying to say. Yeah, what's the this their beta? What's the value of their equity? Or let's bring it out first.
360 million.
That's skinny.
360 million.
But let me bring it out first for people that before they'll be asking me grammar. So you say VE. What's the share the
4
value?
naira 50 4 naira 50
4.50. What's the
times
total
80
number?
million shares. 80 million shares.
Million shares. What do I have?
360 million.
360 million. For Vidingo.
1050 over 102.
Eshe. Thank you. 1050
divided by
1000 multiplied by what?
340.
Multiplied by 340. No book.
340, not 350.
340.
Sorry, not too much, Gary.
357 million.
So let's go and bring this. Yeah. Okay, let's go and bring it here. So here you see your 360 over 360 plus 357. What are our tax rates?
20%.
0.8. What do I have? Don't let me do it like this. I don't want. I really do not want stress. 1 minus 0.20. 1 minus 0.20 will give you 0.8. That's why I just wrote it down abstractly.
Two point eight nine. 0.89.
0.89. Now this is where the problem now. This is when the problem now starts. You know, you've gotten your. I know, is it BE? The BA.
It's BA.
You know, you've gotten your. You've gotten your BA now. But the problem is, this BA you got is not the BA of the entire organization. Ms. Chika, listen now. You need the BA of the entire organization. You know, this equity beta is for AP, is the general one. But we need the BA, the asset beta of the entire, but we have asset beta of non-agricultural. So this one that we got now is for agricultural. So we need a BA of the general organization. I know some people's mind. Let's add it now. Let's add the 0.89 to 0.80.
Excuse me, sir.
We're done.
Excuse me, sir.
Hmm?
Please, the figure is wrong. I got 1.482. Please, can someone confirm?
You cannot get 1 point, sir.
You cannot get 1 point. 1 point is too much. 1 point what?
1.482.
No, it's 0.89.
0.89.
0.89.
You cannot get 1 point. 1 point is actually too much. You know, I told you before that these are some of the cross checks. These are some of the tricks. People used to call me check man. These are some of the tricks. In all situations, somebody's unmuted and I'm echoing. Please help me with your mic, I beg. Ugola, please help me now. Help me. Thank you. So as I was saying, these are some of the tricks that you will consider. In every situation, your equity beta must always be bigger than your assets beta. Yes, now your equity beta must be bigger than your asset beta. So now, but for this particular question, 1.4, yes, 1.4 is smaller, agreed. I'm just saying, I'm talking based on a mistake. Oh. So these are some of the cross checks that she would have known that she was wrong. 1.4 is smaller, fine. But the thing is, this 0.89 that we got is for one department. It's for the agricultural sector alone. We have agricultural sector, we have no. So if 1.4 is for agricultural sector, for it to remain 1.6, for it to meet 1.6. So I don't think that's why I said that 1.4 is wrong. So madam, please try it again. So now as I was explaining, let's go back to this our question. They gave us our equity beta for the entire organization. But when they were giving us the asset beta, they now gave us asset beta for non-agricultural maintenance sector. Non-agricultural maintenance sector 0.8. But we've gotten what? We've gotten the 0.89 is the asset beta for what? For the agricultural sector. And now let's go on. So we'll how would I say it? We'll fuse it together so that we'll now get, don't add it to, in some people's mind, you want to go and add it in here, don't add it. So this is what you will now do. So you will now say, so you say BA, coming on. So we say BA for let me say agricultural sector BA is equal to 0.89. Abi? So you now say BA for the entire organization is equals to, let's replace with X. That's what we are looking for now. So you now say, yes, you will make this 0.89 the subject of formula. So you say 0.89 is equal to, I think that thing was 15% now.
Yes. Yes.
Which is in the agricultural sector. So you now say 15% on Shedaino. So you now say 15, like 0.15% x plus 0.85. That's 85% now, I mean 85%. Since it's 15, we use 15 for this one. So the 85% times what's the name now? What is the English I won't below now? What is the the asset beta of that?
0.80.
0.80.
Maintenance. Non-agricultural.
0.80. So if you say 0.89 is equal to 0.15x plus what was this multiplied?
0.68.
0.68. So if you do cross multiplied, what do you do now? Like times, so now
Yeah,
do
exactly like
0.15x is equals to 0.89 minus 0.68. What's by x awake?
One point
1.4.
1.4. So Jeff, so you say then that is the BA of the entire organization is equals to what? 1.4. Somebody let me add 0.80 to 0.89. What do I have? 0.80 plus 0.89.
1.69.
1.69.
69.
Yeah, so I'm just trying to let you know, I don't add it. If you add it, it will not give you the same thing. So don't just add it together. So this is the asset beta that we're now going to gear now. So you now say we gear the BA. So if you come here, you now say BE is equal to BE plus BA minus BD. If people are selling, people don't know this formula. It's not formula people know.
We know that value of debt over value of equity.
Debt and value of equity into 1 minus 3.
Yeah. Now just as not silent or maybe you don't know this one. There are two formulas. That other one too, you use it to give you the same answer. Formula just full everywhere. Go that big. Yeah. So what's my BA? 1.4.
1.4.
1.4 minus 0. What's my value of debt?
57 million.
Yeah?
357. No. Yeah,
Now don't start.
1.845. 1.845.
Value of debt.
357 million.
That's it now.
Debt is 776. Debt is 776.
776 now. 776. This is your own. You are again with your own
Oh,
company.
sorry. That's for the proxy company.
That 357 was for the proxy company. This is our own. This one that we got.
Sir, forgive him. Head down full.
Sorry. So you now come here, say 776.23 over 1845. 1 minus tax rate 0.80. So what do I have? What do I have? Board mass. Do all this bracket first before you do this addition.
1.87. 1.87.
1.87. Is that what everybody had?
We are trying to confirm.
Confirm.
1.87.
That is correct. Thank you. So you now say calculation of cost of equity using CAPM. That's your cost of equity equals to RF plus BE RM minus RF. Abi?
Yes, sir.
Okay, KE equals, what's my risk free?
4%
plus 1.87. What's my market return?
6.
The market return is 6. So it says 6.
No, we are giving premium. We are giving risk premium.
Okay, so risk premium. So you just say 6. Please, if you see RM minus RF, you also miss risk premium. So if you are giving risk premium, just go and put it direct. RF minus RF is also risk premium, please. So KE equals what?
15.22.
15.22. Lastly now. Wait first though. Wait first. Okay. When you know SFM too much, there's just a way that your head will be banging. When I said wait, because the next thing it's supposed to calculate our work now. But I'm like, okay, sorry, I think I saw we did free cash flow to equity first. So am I using work? I'm supposed to discount my free cash flow to equity with my cost of equity. That's why I said wait. But now remember that this is a new question. This one is a B part question. That we should calculate this is the cost of capital here. So I think that's why we can now go ahead and so let's say calculation of work. Calculation of work. So work, what's the formula for work?
Cost of equity times value of equity.
Times value of equity plus value of equity plus value of debt.
You want to kill me. Formula. I'm writing formulas and money.
Your laughter now, wow.
You should go and write that one too by yourself. Oh yeah, what's my cost of equity?
15.22%.
10.22% multiplied by what's my value of equity?
Why is it?
So 1845 plus 776.23, have we? Plus
yes
4.8 times Ask that question that is on your mind. I know there's one question that is on somebody's mind. Ask it. Nobody wants to ask me anything.
There are plenty questions in my mind, though.
No, I mean concerning this one.
We use 4% when we are calculating capping, but now we're using 4.8% for what?
We use waiting.
4%.
4% for
capping. Okay, it's different.
we use 4% for CAPEM. Where we are using 4.8 for this one. That's not even the question I want to hear, but that's actually still that's still very smart. CAPEM is CAPEM. CAPEM is risk free. It's not cost of debt. The thing is, cost of debt just risk free just serves as cost of debt when there is no cost of debt. In a question where there is no cost of debt, we just use risk free. It's not because they are the same thing. It's just because cost we don't have cost of debt, but we have risk free, so it can serve as it. But for CAPEM is not saying use cost of debt. It's strictly risk free. Don't go and add your credit spread to it. CAPEM is strictly risk free. But for this WACC is cost of debt, which is what we've gotten when we calculated our bond valuation. That's our yield to maturity. That is what WACC uses. But CAPEM is strictly risk free, please. Is it fine?
Yes, thank you.
Sorry, sir. This cost of debt, is it not supposed to be post-tax? Are we taking it?
God will bless you, Jerry. I left it there intentionally because I wanted to explain something, but it's supposed to be post-tax. 0.2. That's the question I was waiting for. Now, where I'm actually going to particularly, why I left it, because I wanted to bring it up, is that if you are doing this post-tax, imagine a question where you have to do, I've explained this to you guys before. Imagine a question where you had to do, this 4.8, we did not really do much. 4 was given to us now, we did not really calculate the cost of debt, we did not do IRR. Now, my problem is, or what I'm trying to say is, imagine a question where you have to do IRR, something like IRR, to get that cost of debt. When you are charging this your interest, listen to me. If you are charging this your interest, you can do it 2 ways. You can leave it the way it's in the book, or you can do this interest post-tax. What I'm saying is, imagine if it was IRR you were doing. So if you are this 54 now, you can come and do 1 minus T of 54. That's the value you will put here. What me I'm now telling you is, don't do the tax twice. Why am I saying this? I'm saying this because of people that like to read textbook. Some people, you read textbook now, you come here, or people that like to read Pathfinder answer. You read Pathfinder answer, you will not see 54 here. You'll be calling me. Then why is their clinic on 54? It's because they've done this one post-tax. But what they will now do is, if they've charged this one post-tax, when they come here, they will not use this tax rate again. So this will just be 4.8. You cannot do it twice now. It's double counting. You can only do it once. If you have charged tax up, don't charge tax here. But what I always advise my students is, if people are used to this formula of this 1 minus T, and you are not used to charging tax from here, so this one, leave it the way it is. Then come and charge your tax at the end here. That's what I always advise my students. I come and charge your tax at the end, because you are used to 1 minus T now here. So if you have charged it up, there's high probability that you come and make mistake and charge it here again. So leave that up the way it is, but come and charge your tax. Yeah. Yeah, the money can suffering. Thank you very much. That's when I said that. That's what I said I should tell you. Work equals, what's my work?
11.85.
11.85%. Let me see, approximately. Approximately 12%. So, Tito, is that all? God, I beg you. Assumption made in your calculation. What are they? You assume risk free to be cost of debt. Now assumption now. You assume you're risk free to represent cost of debt. You assume that all the figures given to you are correct. You also assume that what is the name now? Which other assumption did you assume? I'm assume, Joe. You assume that the asset beta of the company of the asset beta of return given to you. You assume that the asset beta of the non-agricultural maintenance sector is correct. So those are your basic assumption. God, please, beg. I know if I ask any question now, about 3 million hands will be up. But what I feel like our number 2 and our number 3 was very clear to some extent. Most likely it was just that number 1B. So what I know, most of you have questions regarding that number 1B, but please let's do something. Hold that question for number 1B. Let me, how would I say it? Let me practicalize how I can explain it to you better. So I have to, yourself, I'm just, as you are solving it yourself, I'm pressing it here. So let me practicalize a better way. Let me read the question again, then look for a better way to explain it to you. I think that's the only one that is not clear to a very good extent. But I feel like the rest are still clear. So maybe in our next class, that's the first thing I would do. Maybe explain that one bit better. Then but like apart from that one, do I have any other question from any other place? This is up here and let me
Yes,
call
sir.
this. Okay, I don't think the hands up are too much. So I think it's just about 2 people. So are you by Amos? Talk to me, please. Ayuba.
Sir, well, you've already said it. That's the question I wanted to ask. That question on 1D, but
That
I'll
one
send
you
you
are-
when you also
let
ask,
me
and when you explain it, you will get it better.
let me look for, so that I don't elongate the class. So let me look for a proper way, because I know that's where majority of the questions are. Because after I finish, I saw about 2 million on top. So I know that's where majority of the questions are. So let me just let me look for a proper way to explain it to you clearly. I think that's better. Mr. Lucky, talk to me. I can hear you now.
Sorry, sir. Though there's just one thing that is still disturbing me. I don't really understand. In the number 2, the question, the projected statement of financial position that was given, bank overdraft, I know it's supposed to be a current liability, but I don't understand why bank overdraft also appeared as a current asset.
Current assets, care.
Yes, if you check the question, I don't know if it's a
Please,
typo
Anne.
error. Number 2, the financial
That's a
statement.
typographical error, I guess.
Because I've been looking at
Oh,
it
a
since.
mistake. Most likely a mistake. You get it's
Okay,
most
sir.
likely a mistake. Bank overdraft is a liability.
Yeah. Okay, sir. So,
So
no
most
Supposed to
problem.
be cash.
it's most likely an error, anyways.
Maybe they
But
didn't
wait,
specify
though.
bank value.
So in our solution now, is bank overdraft people were calling from now for now? Let me change it here to cash. I beg. People were calling bank overdraft for me comfortably. Let me go share. Me say I don't even notice. Let me change this to cash. I think it makes better sense now. Oh yeah, I think that's better now. Thank you very much for that observation, sir. Mr. Adisha, will you talk to me real quick, please? Adisha, Miss Lydia, talk to me.
So, good evening, sir. My question is just a clarification from the first solution. Please, if you can stroll to that.
Hope you shall know 1B.
Sir?
Is it 1B?
It's a figure actually. I want to clarify. Like I couldn't see it. Changes in income or something.
Should I still be scrolling up? I don't know.
Yeah, the first one.
Okay, this one.
Yes, sir. This table. There's 120. Yeah. The 2,750. I don't know where we got the figure from.
Addition of this one, this one.
Sir?
We just added these two together, and that's what we've been doing. We just added these two.
Okay.
Mm.
But if you add the 17,545, it will not give us 2,750.
We add what?
The 17,500 and then 45, it won't give us 2,750.
What would it give you? Yeah, madam, what would it give you?
22.
Plus 2,750.
Yeah, it's the 2,750 I'm talking about. Where did you get it from?
Just explain to you now. It's addition of 1,500 and
1,500 plus 1,250.
addition of these two.
Okay.
It's just a table. It's just a
You
table.
add
It
the
does not.
vertical and horizontal.
We don't. We added something like this. Add it like this, vertical and horizontal here, like this, like this. I'm just trying to get this total here to add this and this.
Okay.
Thank
And
you.
sir, sorry, this table, is it in the workings or it's supposed to be in the proper solution?
I'll be in your workings.
Okay.
This is the only thing that will be in your solutions. This is the only thing that will be in the page of your book. These 4 lines. Every other thing is your workings.
Okay. Okay.
Yeah, please. Any other question? I think that should be all. Abdul Rahman.
Hello, sir.
Hello.
Okay.
Thank you very much, sir. Please, please we multiply the price of the shares 8 naira 50 multiplied by 1,000. I don't know where that 1,000 is coming from the question.
That's 1B now.
Okay. So the one you
Just,
going to
just hold on with the 1B, please.
right, sir. Thank you very much.
Okay, let me look for a simpler way. If there's another simpler method, that's what I will command.
All right, sir. Thank
Yeah, Mr. Adisha, I can hear you now.
Okay, I was going to ask that one, the 8,820,000. Is it like in value or a number of shares?
It's number of shares.
Like number of shares. Thank you.
No. So please let me
But
just
you multiply it by 8.
by 1,000. That's the exact
You
question
must.
is asking.
Sorry,
So
sir.
I
You
told him
multiply
to
it.
hold on. That's the
Okay.
exact question
All right.
I told him to hold on with it also. So let me run through some of these things here. Do I have anything here? So Mr. Ayuba, talk to me. Okay, I mean question of why did I start from year 0? Year 0 is usually like a current value now. Year 0, when you use year 0 for your cash flow, that's when that's usually like when you want to discount your year 0, you do what's the name? You do 1.00 now because that you're trying to get year 0 is, I told you before, year 0 is now immediately current value, and what we are trying to get in that particular situation also is the current value. We are trying to get our year 0, so we cannot use year 0 again. Leshy, I don't know if you are listening to what I'm explaining to you. What we are trying to do, no, it's not because it's for cash outflow. That still works, sha. You can still say something like that, but anyways, the major reason is because that year zero is what we are trying to get. Because it's a current market value. Anytime you hear year zero, it means that now. But that is what we are trying to get. So it does not make sense where we won't even see the figure from. There's no even figure for it. So there is no make sense. Since that's what we are trying to get, we cannot put it there. And another reason why it cannot be there is when they say when you do when they tell you to do current value is the present value of future cash flows and the only cash flows when it relates to bond, there's no outflow there now. There's no money going out. You are just collecting interest and you're also going to collect your redemption value. So that is the only cash outflow there. That's only cash flow there. There's no cash outflow. That's another reason, anyways. Miss Leshy, I hope that's clear. I'm really open, anyways. Yeah, Emmanuelite, talk to me, please.
Okay, good evening, sir. So please, I wanted to ask a question. Going back to when we did these Gordon's as dividend growth model using the Gordon's. So I don't know. I think I remember when we were doing a class, we did something like the current dividend divided by the base dividend. So that was what I used in calculating that retention rate. Although I have the same answer, but I don't know, is it also the right way to go about it?
Use current dividend.
That's the current year dividend over the base year dividend. Then with the current dividend over base year dividends, then raised to power 1 divided by the number of years.
Why do you want to stress yourself? But funny how to calculate retention rate is very, very, how would I say it, is dynamic. You can, I don't know, there are a lot of, like in this class now, we mentioned about 3. Somebody said earnings minus dividend per share over earnings per share. I use 1 minus dividend payout ratio. You can do average. If you don't use formula, you can use average and it works. So that one too, it might work as long as we give you the same answer. But I would want you to maybe try it out on 1 or 2 more questions just to confirm. But it's a formula that you can use to calculate retention rate also. But just try it out on other questions just to be sure. But I like the fact that you tried it out on this one, and since it gave you the same answer, I think I'll take that.
Excuse me, sir. When I tried it, it didn't give me the same answer. It gave me 12 point something percent or thereabout.
Maybe you didn't calculate it well, anyways. I don't like complex formulas. That's why I picked the one that is easier for me. And anyone I pick, that's the one I always know. The rest no concern me again. So this current base dividend is because I've heard it somewhere before. It's not something I would recommend, but I've heard it. I think I've heard it before somewhere. So that's why I know there's actually a formula like that, anyways. But now the one that taught you what was the name? This cost of capital now. So
I thought we use it as dividend growth.
I think the formula is a normal dividend growth formula, not
normal dividend growth formula.
That's what they're talking about.
Okay. I think I understand what is doing better now. Okay. I think I understand what is doing now. You know, okay. No, now what you did is not particularly Gordon's growth now. So what you did was that current dividend, base dividend, rubbish. I don't know. I don't think it's a good approach. I don't think it's a good approach. I don't think it's a good approach for your retention rate. I don't think it's a good approach for retention rate. It's a formula to calculate growth. Anyways, but still try it. It's like I always say, always open to learn. Try it for another one. If it works, then you can be telling people that you can use it like that, you can use it like that. Yeah, do I have any other talk? None, Abi? Okay. So, on that note, this is what I would want to say. It's going to be getting is going to be getting more difficult moving forward. Though. Our questions from here are kind of very, very thick. They're kind of very, very thick. So please let's get our mind prepared. And our next class is going to be on Monday, please, not tomorrow, please. Monday, 8 p.m. Please. On Monday, 8 p.m. So the ones we've done this night, please calm down, look at it, understand it, try to solve it. If you have any question, bring it to class on Monday. But please try to solve it again on your own. Like I always tell you people, don't do eye contact. Don't do eye reading. Carry Bible, carry book, and solve it. On that note, I think time has gone. It's 12.
You're dropping the WhatsApp in the group chat, right? The computations.
The solution, yes, I will drop them on the group chat. And about the recorded video, I honestly have no idea when it will drop. When, I don't know. But I know that when it drops, I don't know when. It is not going to drop immediately now. Google Meet. It will drop, this class is finishing like 12, so it will drop like 3 a.m. and I will definitely not be awake. So it might be tomorrow morning before you get them. But believe me, you get them very early. Tomorrow is Sunday. So you get them very early tomorrow.
Oh,
Today is Sunday,
thank
sir.
you, sir. God bless you.
What I'm saying, tomorrow is Sunday, so you get them very early tomorrow.
Thank you very much, sir. God bless you.
Tomorrow,
So on,
tomorrow is Monday.
Tomorrow is Monday.
Tomorrow is Monday. Today is Sunday.
sorry. Now that one, you know. I asked for formula for maximum private. You know, answer me. Tomorrow is Monday. Oh yeah, somebody sent them so make I dey go.
Oh, God bless you, sir.
You are welcome. Thank you.
Thank you
All
so
right,
much,
thank you very
sir.
much.
You're welcome. You're welcome. People have learned.
Enjoy your weekend.
You have learned a lot. This will be the way you are thanking me. Anyways, have a wonderful night.
Thank you, sir.
Thank you, sir.
All right. You're welcome. You're welcome. You're welcome.